Good morning, all. It is a great pleasure and honor that I welcome each and every one of you on this insightful webinar on the critical topic of oil and gas navigating challenges and embracing opportunity. Today, we are the privileged to have a distinguished speaker who are experts in the field, ready to share their valuable insight and experience. In a world driven by energy demand, the oil and gas industry remain a concern of global progress. As we navigate through the challenges and transformation, it becomes imperative for all of us to gather, collaborate, and engage in this meaningful discussion that will shape the future of this vital sector. Our esteemed speakers today bring a wealth of knowledge and expertise that spans various aspects of oil and gas industry, from exploration and extraction of refining and distribution. Their perspectives will undoubtedly shed light on the current landscapes and provide us the foresight into what lies ahead. As we deliver into this today's discussion, let us keep in mind the broader implication of our actions within the industry. I encourage each participant to actively engage with our distinguished speakers, ask questions, and contribute to the dialogue. Your active participation will nurture the discussion and contribute to the depth of understanding we aim to achieve today. Thank you so much. Now, I would like to invite uh, Anuj ji and Gaurav ji. Just to give a brief of Anuj ji, Anuj ji is a director in international and corporate tax practice with Deloitte India and based in Gurgaon, India. Prior to joining Deloitte in September 2017, Anuj was associated director with DMR Advisors, a M&A and tax service firm. Anuj has 14 years of experience in advising M&A business on matters pertaining to international taxation, transaction taxation, and exchange control. He has worked with top multinational corporations on their corporate tax matters, holding and financing structures, cash reputations, permanent establishment, and IPs, including several cross-border investments reorganizations involving application of tax treaties. From industry specialization standpoint, Anuj has advised various multinational and domestic companies in the entire value chain of energy sector, including oil and gas, power, LNG, etc. He is working more recently on new age energy offering in green hydrogen, renewables for IPP and dedicated CNI market. Anuj has co-authored several publications published by Forbes, International Taxation Taxman, leading business International Taxation Research and Analysis Foundation, and IFA. For the past few years, Anuj has been contributing chapters on oil and gas and power sector for European Business Group and co-presented pre-budget recommendations to the Ministry of Finance on behalf of EBT. Anuj has also contributed a chapter to tax litigation book Managing Tax Disputes in India. Anuj is a commerce graduate from Shri Ram College of Commerce, Delhi University, and a member of Institute of Chartered Accountants of India. And our next speaker, Gaurav Bharsaji, is a senior manager with Deloitte. Gaurav has more than 11 years of experience in advising multinationals on wide range of matters, including international taxation, transaction tax, and exchange control. Gaurav specializes in advising clients in matters pertaining to investment, structuring, tax optimization, exit planning, contract review and structuring, and tax litigation strategy. Gaurav has, to his credit, as a member of research team, the book titled Tax Dispute Resolution: Challenges and Opportunity for India. Gaurav has, to his credit, as a member of research team, the book titled Tax Disputes, published by LexisNexis. Gaurav is a graduate from Shri Ram College of Commerce, Delhi University, and is a member of Institute of Chartered Accountant of India. So I welcome Gaurav ji and Anuj ji for his deliberation on tax consideration for oil and gas industry.
Thank you, Arijit ji. Thank you for the generous introduction. It was a bit long, but thank you so much. I think if you allow, we can get started in the interest of time. Okay. Okay, so Gaurav and I will take turns to take you through some of the tax nuances in this sector. I think the way we'll organize is probably in next 70, 80 minutes, we'll cover this topic. We can just leave 10, 15 minutes towards the end dedicated for questions and answers. But feel free to put in your questions in the chat box. Uh, we'll try our best to take up your questions to the best extent possible. In case we really fall short of time, we'll ensure that we get back to you by written responses. We'll focus more on direct tax, at least in next few slides. But just for completeness, we've covered a slide on indirect tax stroke GST issues as well. But really focus for next 70, 80 minutes will be more on direct stroke income tax issues impacting the industry. Or we can move forward. Yeah. I think before we go deep into the sector, let us just understand as to how is this oil and gas sector organized in the Indian context. Look, this is one of the 8 core industries that we have in India. It is a very important pillar in the Indian economical setup. The oil and gas, particularly, they contribute roughly 35% to the primary energy consumption. So you're looking at this industry contributing to the Indian exchequer by way of taxes, duties, royalties, cess, petroleum. It is significant contributor to the exchequer. If you look at, say, projections in future, the demand for oil and gas is only going to rise. Today, we have a rough estimate of, say, 5 million barrels per day. That demand will go, say, 40-50% up to roughly 7.5 million barrels per day in 2030. So looking at a significant growth of oil demand, and this really emanates from transportation, from petrochemical, which are major demand drivers of oil and gas. And the question that begs here is, do we have abundance of oil and gas production in India? The answer to that is a big no, for 2 reasons. One is oil and gas, they come from fossil fuels, which are finite. And therefore, really production has to be calibrated so that we don't fall short of or we don't exhaust all the fossil fuels in India. And if you look at statistics on imports, India imports roughly 85% of its crude oil requirements from outside India. This is a significant, staggering import number that we have on this oil and gas imports. We have been reading, hearing a lot about drift towards renewables, which are more sustainable sources of energy. While that is clearly the way to go in future, because the energy mix currently, which is skewed towards oil and gas, coal being thermal source, will likely see a more dependence on renewable sources in future. The government has very ambitious targets to reach a particular renewable energy capacity, but that does not mean oil and gas really impetus or focus is going to go away anytime soon. I think in near foreseeable future, probably I think many years down the line, we'll see continued focus impetus on this industry from the government. There have been a lot of policies that have been offered by the government to promote production of oil and gas. We see 100% FDI allowed in this sector, both in production and in refineries, where really it is a welcome sector for investments from foreign sources. This is the reason why at least we'll spend few minutes on this sector, because this is significant. This holds significant value in the economical setup or the framework of the country. Now, I think, with that background, let us just move into the broad industry segments. We talk about oil and gas. There are 3 broad segments that we look at. To start with, there is upstream. Now, upstream is a sector where a lot of activities relating to oil exploration, development, production take place. It is also known as exploration and production segment, where the top 2, say, exploration or upstream companies in India would be ONGC, PSU, and Reliance. You would have seen probably a week back, the government announced oil discovery in Krishna Godavari Basin. This is really 30 kilometers off coast of Andhra Pradesh, Kakinada terminal. This is a discovery that has happened out of the result of upstream operations. So this is what upstream operations do. They help in oil discovery, which really is significant in terms of the experts or really the efforts that go into exploration processes. Midstream is because the oil sources are far flung from the seashores. To get production closer to the shores, to get production closer to the market, is what midstream players do. Midstream is a vital link between the production areas to where the consumers are located. We have GAIL and Petronet as major players in this sector. Now, extreme right is the downstream sector, which is where all the activities around refineries, around conversion of crude into finished goods, such as, say, petroleum products, or plastic, synthetic rubber, etc. All of these activities take place. You look at top two downstream companies, will be the IOCLs, BPCL, HPCLs. This is where the sector is dominated. So this is the broad swing of segments in the oil and gas sector across the spectrum. Now we have a picture in the next slide, which will really give you how really a sense of how this structure is organized. Because you look at petrol or these oil blocks, oil or gas blocks, they are in their natural state property of the government of India, because they lie in the territorial waters, exclusive economic zones, or the continental shelves of India, and therefore property of the government of India. Now, government invites tenders. They invite bids. They issue tenders to invite bids from various private, public players to bring in the financial and the technical wherewithal, do exploration activities, ensure that the oil discovery or the gas discovery takes place. Now, because this is significant in terms of finance, technology, we've seen more often that they're done in consortiums where 2 or 3 players come together, bring their financial and technical competencies, and submit their bids in response to tenders which are floated by the government. Now, because we're looking at oil blocks, there are long-term leases that are given, which is license come lease, which are offered, given by or signed by the government with a consortium or with the private or the public players, contractors, we can call them so, that sign up exploration licenses with the government of India. The contract that is signed by the contractor with the government was called as a production sharing contract a few years ago. It is now called as a revenue sharing contract. We'll understand as to what is a production sharing contract vis-a-vis a revenue sharing contract as we move along. But that's the terminology that is used in defining the contracting between the consortium or a contractor and the government. And the back end, there could be, say, bidders, as we spoke about, bidder 1, 2, 3, which bring in their technical financial might to ensure oil discovery or gas discovery takes place. There could also be various foreign players in the back end, which foreign players will bring in their technology. They'll bring in their expertise to ensure they're able to support the contractor, say, with their technical sophistication in the process. So that's how this is organized. This contracting at the first level, which is at the consortium level, which we typically call as operators of the oil block. And in terms of, say, if there are 3 bidders which submit their bid is accepted, letter of award is issued, they sign up contract with the government. Now, they will have their equal participation in the oil block, which is what we'll call them participating interest. Like a shareholder holds shares. In this case, the bidders or the contractors, if there is more than one, then they will hold a participating interest in the oil block or the gas block. And that participating interest will be an intangible asset for these bidders, for these contractors. They may have on the extreme left foreign companies really providing their technology in say, seismic drilling activities, which are separately taxed, and we'll discuss them more in slides to come. Or we can move on. We'll cover these different elements in more detail in subsequent slides. Okay. Yeah. So this is the contract, and Gaurav, feel free to add in case you have any additional inputs.
Sure.
So this is the contracting between the first level operators of oil block and the government. On the left, you see a production sharing contract, PSC. On the right, you see a revenue sharing contract, RSC. Now, Now, until roughly 2016, there was a policy or a fiscal regime that existed, which fiscal regime we called as NELP, New Exploration Licensing Policy. Production sharing contract was a part of that NELP process, NELP fiscal regime. It operated in a particular manner. And just to give you more details on how the production sharing contract was organized, it worked on the basis of profit sharing with the government of India, in the sense that there'll be recovery of costs first for the contractor. Say, for example, contractor incurs 100 worth of costs. Now whenever there is commercial discovery that takes place, that commercial discovery will happen. There'll be sale of oil or gas. Now that sale proceeds will first be attributed towards the cost incurred by the contractors, and then after recovery of costs, any profit petroleum will be shared with the government of India. So that's how this model was organized. Now, what it did was not very efficient, and it ensured, and there have been delays and disputes between the government, because the government required very closer scrutiny of costs that have been incurred by the contractor. There were allegations that contractors were gold plating their costs. They were inflating and showing higher costs to ensure more proceeds go to them. I think, yeah, so there were inefficiencies, delays, and disputes, and therefore it was not very efficient model for oil exploration processes. There was a committee that was set up. We call that Rangarajan committee. That was set up in 2012, which issued recommendations that there have been disputes pending all the way to the Supreme Court and in arbitration centers. Let us look at a new policy, a new regime, which is now known as HELP. This is a hydrogen or a hydrocarbon exploration licensing policy. Under that policy regime, we have a revenue sharing contract which operates differently, not on cost sharing, but on revenue sharing, where the government ensures minimum supervision of costs and maximum governance. They're concerned with the output, not on what the contractor incurs in terms of costs. Whosoever bids highest revenue share to the government wins the contract. So the bidding also is very differently done. There have been few more interesting features of RSE, because RSE comes under Hydrogen Exploration Licensing Policy, which covers a lot of hydrocarbons in general and not limited to oil or gas. It covers CBM, which is coal bed methane. It covers shale gas. So there are a lot of hydrocarbons covered within our RSE framework. So you take one license, you sign up one contract, and you can do exploration of a lot of hydrocarbons in general. You have marketing freedom under RSE framework, which did not exist in the PSC setup. Another important part of RSE is conventionally, government used to identify blocks, used to put them on tender, invite participation from the contractors. Now, there is a national data repository which is set up by the government of India, which has a lot of data about different blocks that India has in the sedimentary basins. A huge repository of data sits in there. Now, wherever contractors and they have access to that information, wherever they believe that a particular oil block may have a potential, say, possibility of discovery of oil or gas, then they can invite their bids. They can submit their bids on their own, which is what we call as open acreage licensing policy, without waiting for governments to offer or to invite bids for those blocks. Contractors on their own can go submit their bids, show their participation for exploration in those blocks. So there has been that shift from production sharing to revenue sharing. What revenue sharing does in terms of benefits is it ensures minimum government intervention for cost review. It ensures government is able to take their share by revenue sharing, not by profit sharing after recovery of costs. It ensures really minimum governance and maximum result. It really is a measure towards ease of doing business for the contractors in India.
Wanted to add that this open acreage licensing policy has been a real success. So the recent discovery that ONGC did just a month back was in respect of oil and gas blocks under the OALP policy of the government. So that in a way further goes on to prove that how flexible the government has been and how it has really translated in terms of having more and more discovery in the real time.
Yeah, it is one of the major hits. The
Absolutely.
OALP. There've been discoveries of oil under this policy.
Yeah.
We can move on. Yeah. Now if we look at how tax works for operators of oil block, there is a separate code in the tax law. That code is codified in Section 42 of the Income Tax Act. Section 42(1) particularly deals. It governs taxation of income that operators of oil block generate when they sign up contracts with the government of India. That is a very different looking, very separate code vis-a-vis other provisions of the tax law that typically apply in computation of business income. This is very differently worded. Now, if we were to look at 42(1), which will really detail out what costs are deductible, how are they deductible, when are they deductible, and what costs are not deductible. Now, one important part is 42(1) is to be read with the underlying contract. And underlying contracts earlier, which used to be production sharing contracts, they are now revenue sharing contracts. Now, the way 42(1) is written in the tax law, it says that deductions for determination of taxable income will be determined and expenses will be allowed in lieu of or in addition to the provisions of the Income Tax Act. So wherever there is an additional deduction allowed under the contract, it will be allowed regardless of what exists in the tax law. And therefore, it becomes very important that you read both the tax law and the underlying contracts, which is a revenue sharing contract or a production sharing contract, as the case may be, to ensure that the computation is then rightly done. Very broadly put, because not all exploratory efforts are successful. There have been cases where there have been a lot of technology, finances that have been resourced, that have been put together, incurred in exploration activities, which have not borne fruits, and eventually had to be infructuous or abortive. Then the law now provides that those expenses shall be allowed as deduction before or in case of areas or blocks which are surrendered before the commercial production. So if there were to be, say, expenses incurred for several years, 4-5 years, which ultimately did not bear fruits, they eventually turn out to be infructuous or abortive, they'll be allowed deduction. And they'll be allowed deduction when at the time when the blocks are surrendered before the commercial production. Now, when commercial production is successful, discovery does take place. All expenses that have been incurred from day one towards drilling or exploratory activities or physical assets that have been purchased in connection with these activities shall be allowed as deduction, both revenue or capital, and they'll be allowed as deduction from the time the commercial discovery or the commercial production takes place. So that's how the deduction provisions in the section in the tax law are provided. Now, as I said, they are to be read with the contracts, RSC or PSC as the case may be. And these are contracts where the government signs up its contractual stipulations with the contractor. Now, there is a particular article in those contracts which specifically deals with tax provisions. If you were to look at a model PSC, production sharing contract, which used to exist earlier, Article 17 typically had tax provisions. And we're here only looking at model provisions. The actual provisions or actual contracts could be differently worded, but they'll broadly be aligned to the model framework. So on the right in the table, you see Article 17 of model PSC, which further details out what expenses are deductible, how are they deductible. And you see there it is more explanatory than what is provided in Section 42(1). It goes on to say that expenses towards exploration and drilling will be 100% deductible, regardless of capital or revenue nature. It goes on to say that production and development expenses shall be allowable as the provisions of the Act. The revenue, they are to be allowed in full. If they're capital, they are to be amortized over useful life. Unexplored or unsuccessful exploration costs where there is no other unit that has started commercial production will be allowed, or all those costs will be aggregated, and deduction will begin from date of discovery of commercial production. Now, Article 17 also allows you an option that drilling or exploration expenses you could amortize or you could aggregate and amortize over 10 years from the date of commercial production. Now, there is a framework that is provided in the model PSC, read with section 42.1, which really read together just does give a lot of enabling framework as to how profits will be computed for tax purposes. But is this sufficient? Answer is probably not, because there's still some gaps which are left. But before we go to those gaps which are left, let us go to what the new contract says. There is Article 13, which is very broad, very open-ended. It simply goes on to make one statement to say that all expenses incurred on exploration, development, or production shall be allowed as deduction under Section 42. So it is as broad or as narrow as it could be. Just one simple statement to say that expenses across spectrum, exploration, development, production shall be allowed as deduction. Now, the question that arises is, does it clarify enough or not? And I think with that, we could go to the next slide, Gaurav. There's some issues which probably beg a lot of questions, a lot of clarifications from the government. Really, on a sample basis, if you were to look at deduction of development and production expenses are clarified under 42. Now, RSE, as we said, it simply goes on to say that all expenses on exploration, development, production will be allowed. But 42 hasn't changed, or really 42 only covers exploration and drilling. There is no reference to production or development expenses. Now, does it mean that there is disconnect between RSE and Section 42.1? Answer is yes. Does it mean that production and development expenses will split out? Answer is a yes, but it helps to have clarification on this front. Because unlike production sharing contract, which details a lot of mechanism, revenue sharing contract does not. It just simply provides enabling framework without mechanism of when and how those expenses are to be claimed as deduction. There are discussions on how do you determine date of setting up of business, because that is important from the perspective that some of the expenses will be allowed only from that date onwards when the commercial discovery takes place. Expenses afterwards will not be allowed as, or expenses before that will need to be aggregated, and some of the expenses may not even be allowed. So there are disconnects between the contracting framework and the provision in the law. There are instances where there are more say situations of expenses which are not even covered by the revenue sharing contract or the production sharing contract, and then there is ambiguity of how those expenses will need to be allowed. In addition, the more provisions in the tax law regarding certain expenses that will be claimed as deduction. For example, site restoration allowance. There is a provision in the tax law that the contractors need to allocate a particular amount to a dedicated bank account as a site for a site restoration activities. Now, whatever deposit that is done by the contractor towards that fund will be allowed as deduction that is provided in the tax law. There are checks and balances that the amount which is allocated to that fund can only be used for specified activities, which is really sharing profits with the government and cannot be used for other business activities. And if it were to be used for unspecified activities, then it'll be deemed as income in the year in which it has been used for non-specified activities. So there are deduction provisions, but the key takeaway here is wherever we look at determining profits or gains for oil operators, so gas operators, as per Section 42 of the tax law, one is it must be read with the underlying contracts that are signed up with the government, because there is a production bonus that is paid to the government. That production bonus will be allowed as deduction. If any part of it is unpaid, that is not to be allowed. There'll be site restoration expenses that'll be allowed to be that should be claimed as expense. So the second point is you have to look at all contracting terms, whatever is paid, whatever is unpaid, other provisions in the tax law to come to a harmony and then really work out what final tax for final profits will be determined with in accordance with both the tax law and the contracting framework. So Gaurav, I will now hand over to you to talk about another provision which really deals with transfers of participating interest, which popularly we call it farm in, farm out.
That's right. Sure, Anuj. So, Section 42(2) of the Income Tax Act, it provides for taxability of capital sums received on account of transfer of either the E&P business as a whole or transfer of participating interest in a PSC or an RSC. So, well, the basic thing that really happens is that there is a contract that the E&P operator has with the government of India in terms of a PSC or an RSC. In that particular contract, each of the operator would hold a participating interest, and that particular operator under the PSC and the RSC would have the right and the flexibility to transfer of the participating interest to let's suppose some independent entity. And the reason could be manifold, right? The reason could be that there is a lack of budgetary funds, or there is a lack of technical know-how, or lack of the risk appetite of the operator because no discovery is really happening. So on account of that, this transfer can really happen. And it is very important to then understand is that how does this transfer is treated under the tax laws. And this is where Section 42(2) of the Act really throws a guiding light, and it provides for tax implications in the hands of the seller. So there could be two situations. The first situation could be that what happens in case the capital proceeds, which is the sales consideration, is a lower number than the expenditure remaining unallowed. Now I'll just take a pause here to maybe explain as to what do I mean by expenditure remaining unallowed. So there could be some situations wherein the taxpayer, the seller entity, would have not maybe claimed all the expenditure. Maybe some amortization is going to happen for which the tenure is not yet fulfilled, or maybe there could be some drilling expenses which is yet to be maybe claimed by the taxpayer. So that could be a expenditure number which is yet to be claimed by the taxpayer, and hence should be clubbed under the nomenclature expenditure remaining unallowed. So the case wherein the sales consideration would be a lower number than the expenditure remaining unallowed, in that case, there would be no income as such. There would be a negative income, and accordingly, the difference of these two figures would be allowed as a deduction in the year of transfer. So in that case, the seller operator did not wait for the future years to really come so as to claim the deduction, but claim the entire balance amount, which is net of the sales consideration in the year in which the transfer is really happening. So this is pretty simple and straightforward. Complication really arises when the capital proceeds or the sales consideration number is a bigger number than the expenditure remaining unallowed. Now, logically speaking, the difference between the two would be an income, right, and which has to be offered to tax. Now, the section says whatever it wants to say, and in a very complex manner. I'll just try to decode that so that we understand it better. So the rule really is that the income, which is the difference between the capital proceeds and the expenditure remaining unallowed, would be allowed as a business income, would need to be offered to tax as a business income to the extent of amount of expenditure already claimed by the taxpayer. And the amount over and above this particular threshold would need to be offered to tax as capital gains. Now, I do recognize that this would be really difficult to maybe understand and explain in the first go. And just to make sure that we understand this thing better, we have outlined a numerical example in this particular slide.
I'll just take probably a couple of minutes to just if you can just move back to the last slide. Yeah. I think for the audience to understand why are we spending time on this is because I think if you look at a case where there is a transfer of shares, then transfer of share is an asset. This transfer of shares, then that leads to the capital gains. You look at the manner in which capital gains are worked out, you apply tax rate to determine the tax liability. Now, there is a similar analogy we can draw here. These are contractors holding participating interests in oil blocks. Now, if there were to be a transfer of participating interest in oil blocks, now there will be income, there will be proceeds that will be received on transfer. Somebody can come in laterally, say secondary acquisition of participating interest from existing operator. Now, how is that income to be determined for the seller, and what is the tax rate to be applied on that income? What is the characterization of income? Is the characterization business income or capital gains? and accordingly tax rate will be determined. So this is how and why we are reading it. And some of the terms we've used here: capital proceeds, they're nothing but sale proceeds on transfer of participating interest. Expenditure remaining unallowed, expenditure remaining unallowed, and expenditure allowed are different terms, because we've in the preceding slides we've done discussions so much on various type of expenses: exploration, production, development, and we've also understood that not all expenses will be allowed as deduction in year one. They're staggered. Some of the expenses are allowed 100% in the year of incurrence. Some are aggregated. They're allowed as deduction later in time. Now, whatever is incurred but not allowed, or allowed or deferred to be allowed in subsequent years, that is what we call expenditure remaining unallowed. What is allowed is already allowed, but what is unallowed is to be allowed in future. I thought just I'll make these terms clear. And why are we reading this clause? Because it impacts. And this is very frequent. It has happened where we've dealt with a lot of contractors which have sold their participating interests. In those business instances, you need to look at this provision and determine how is income to be determined, and how will tax provisions apply. Gaurav, back to you.
Yep, that's quite helpful, Anuj. Thanks for that. So maybe we'll go to the next slide, wherein I think we have carved out a numerical example just to make sure that we understand this thing better. So situation one is a situation wherein the amount of sales proceed is a lower number than the amount of expenditure remaining unallowed. So the total expenditure incurred is, let's suppose, 10,000. Expenditure which is remaining unallowed is 6,000. That impliedly means that the expenditure which is allowed is 4,000. And this is an important number to bear in mind as and when we go forward. The proceeds on transfer is 5,000. So what typically happens is that because the amount of sales proceed is a lower number than the expenditure remaining unallowed, the remaining amount of 1,000 would be claimed as an expenditure in the hands of the seller entity in the year of transfer. That's a plain vanilla straightforward example that typically works out. Now, what happens in case the amount of proceeds on transfer is a bigger number than the amount of expenditure remaining unallowed, which is in a way is captured by situation 2 and 3. Let's take up situation 2. Let's suppose the total expenditure incurred is again 10,000. Expenditure remaining unallowed is 6,000. This means that an amount of 4,000 has already been claimed by the seller entity till now. The proceeds on transfer is, let's suppose, 7,000, because there's a difference between the proceed of transfer and the expenditure remaining unallowed in a positive manner. There would be an income of 1,000 which would need to be offered to tax. Now, the question of whether 1,000 will be offered to tax as business income or capital gains, for that we need to refer to section 42(2). And basically what it says is that amount of expenditure to the extent of amount already claimed as expenditure by the taxpayer would be offered to tax as business income. Let's complicate the situation and let's go to situation 3. All the facts remain the same, only the amount of proceeds of transfer really changes. So let's suppose we have a 15,000 number now. The excess of proceeds over the expenditure remaining unallowed comes out to be rupees 9,000. This needs to be offered to tax very clearly. But again, now we are at the crossroads that whether this amount needs to be offered to tax as business income or capital gains. For that, we again refer to section 42. Expenditure till the amount of expenditure already claimed by the taxpayer would be offered to tax as business income, and the over and above amount would be offered to tax as capital gains. This is the 4,000 and the 5,000 number respectively. I'll just stay on the slide for maybe 10-20 seconds so that you are able to absorb the number better, and then we can move forward. Anuj, feel free to add in case you have any comments.
Yeah, I'm sure. I think there'll be questions that'll be really. I think we are compiling in the chat box. Arijit, we can pick up those questions as they keep on coming, probably towards the end. And in case we're not able to attend to those questions in the interest of time, you let us know and we'll get back by written responses.
Sure. So we will take up the questions at the end of the session.
Sure, makes sense.
Great.
Yeah, got back to you.
So moving on, and this is an interesting, topic to maybe discuss, and everybody who would be following the oil and gas news would be knowing about the terms farm in and farm out. Very simply put, farm in and farm out refers to purchase and sale of the participating interest in the PSC or the RSC. As I said, typically an E&P operator who has a PSC and RSC with the government of India would have the flexibility to sell off their participating interest to an independent party. And this can happen at any point in time in the overall life cycle of an EMP block, right? So maybe the transfer of interest can happen maybe at the exploratory phase or maybe at the developmental phase. But generally, in our experience, we have seen that this transfer of interest happens in the latter phase of development, wherein the discovery has already happened, and there's an added incentive for the buyer to maybe then participate in that particular RSC by way of acquiring the participating interest, because there's an assured guarantee that there is already a discovery that has happened and which is done by the earlier operator. Now, again, I think logically speaking, if we were to think more, in case of any resource which is there in a particular territory, that's the property of the government of India. And government would need to, give out a right to another party to do the maybe drilling and exploration and production of mineral oil by way of an explicit right. And this is the right which is called as participating interest that we clarified just a short while back. And the overall tax regime in case of a buyer and a seller is quite different. So section 42(2) subsection 2 defines the contour of taxation in case of a seller entity. There is no guidance in terms of what happens to a buyer of those participating interest. Now, this question reached out to the appellate levels, and tribunal in one of the rulings in 2014 clarified that whatever the amount is paid by the buyer entity for the purchase of the participating interest, that should be classified as an intangible asset. And the reason is that this particular right is akin to a commercial or a business right, more like a license, and hence should be classified as an intangible asset. And of course, then the buyer entity should be eligible to claim depreciation on this particular intangible asset. Now, this particular point of view has been affirmed by multiple court rulings, and in a welcome move in 2019, this was also clarified and accepted by the CBDT. So as on today, there is a circular of the CBDT which in a way clarifies this position of law. And to that extent, this is a very welcome move which provides a lot of relaxation to the buyer entities, because anybody sort of investing such a huge fund can now very freely, recognize this acquisition as an intangible asset and claim depreciation during the life cycle of the block. The depreciation would start from the year in which the commencement of activities really happen. And this is in line with the general reading of section 32 of the income tax law, which really says that depreciation in case of an asset should be available from the year in which it starts to actually do the production or commence the business. Yep, moving on, maybe we can go to the next slide. And let's quickly discuss as to, what are the typical tax issues in case of a non-resident service provider in the upstream sector. And it would be really, underwhelming and unwarranted in case we don't talk about the much celebrated section of Section 44BB. Simply put, Section 44BB of the Income Tax Act is a presumptive tax regime that is applicable in case of a non-resident service provider. So it is applicable to both corporate and non-corporate taxpayer, which are engaged in the business of providing services or facilities in connection with or supplying plant and machinery on hire used or to be used in the prospection, extraction, or production of mineral oil, which is perhaps the upstream activities. The section provides for a simplified tax regime by saying that 10% of the gross revenue would be deemed as income, and applying a corporate tax rate which is applicable to that particular category of taxpayers. So for example, in case of foreign company, the corporate tax rate is 43.68%. So the effective tax rate really works out to be 4.368% on gross income basis. So quite an incentivized scheme for a non-resident service provider. And more incentive is provided in terms of by providing that there is no requirement to prepare the books of accounts. In case the non-resident service provider opts for this particular scheme, there is no need to get the books of accounts audited by a tax auditor for tax purposes. However, the section really also provides an flexibility to say that in case the non-resident providers, they envisage the profit to be less than 10% of the gross receipts, then there's an option to maybe maintain the books of accounts, get the same audited, and then claim the lower profitability rate in their return of income as the taxable income. MAT is really not applicable because this was clarified by the government in 2019 very clearly. So when you look at the feel and shape of this particular section, the template of the section, this section comes out to be a very straightforward, very simple section, which in a way bodes really well with the overall legislative intent of the government when it introduced this particular section. But unfortunately, this section has become a minefield of litigation, largely due to the way the amendments were brought into the law. There was no clarification granted by the government and so on and so forth. And the reason that has created a lot of debate as far as applicability of this section is concerned is because of the carve out that forms part of this section. So the carve out in the section really says that this section 44BB would not be applicable in case of income is in the nature of royalty or fee for technical services. And if it is so, then provisions of section 44DA and 115 capital A would be applicable. For a quick recapitulation, section 44DA provides that in case of a non-resident taxpayer who is earning income in the nature of fee for technical service or royalty and has a permanent establishment in India, which is a PE in India, then taxation needs to happen on a net income basis. The non-resident service provider would be required to maintain the books of accounts in India, determine the margin, and pay a tax at the rate of maybe 40% and whatever the applicable rate really is on that particular margin in India. Similarly, section 115 capital A provides that in case of a non-resident taxpayer earning income in the nature of fee for technical service, and where such non-resident taxpayer does not have a permanent establishment in India, then taxation should happen on a gross income basis. And section 115 capital A provides for a tax rate of 20% for financial year 23-24 and 24-25 on a go-forward basis. And this is where the debate really arises, that what are the streams of income and taxpayers which are sought to be covered by 44BB, and what are the streams of income and the taxpayers which are sought to be covered by 44DA or 115 capital A of the Income Tax Act. And
Got
the
one
answer-
question. Sorry, I think you can answer that, and I have a question for you then.
Yeah, sure. So maybe you can ask the question and maybe I can take it up.
Okay, I think Gaurav, just for the audience also, maybe you can cover why is and how is 44BB different from 42(1), and fact
Absolutely.
that
I think it's a valid
yeah.
question, and I was about to maybe cover that as well.
Okay.
So very fair question, and I think it's a very fair confusion to also have that what are the cases in which 42 is applicable and what are the cases wherein 44BB is applicable. As Anuj said a short while back, 42 is applicable only in case of computing taxation for the operator. So let's suppose ONGC or Kane, who has a PSC agreement with the government of India. In those cases, you apply 42. But let's suppose those operators, they identify a subcontractor and subcontract a part of the scope to that particular subcontractor. Then in those cases, section 42 is not applicable, but section 44BB needs to be referred to. So that's the fundamental difference between both the sections. Now, as far as applicability of 44BB is concerned, as I was saying, there has been a lot of debate as to is 44BB applicable in case of a subcontractor in the first place? Or would the provisions of 44DA or 115 capital A would be applicable, because these sections, they seek to, tax the income in the nature of fee for technical service. And the answer really lies in the way the term fee for technical service or royalty has been defined in the income tax law. And just to make sure that we are able to refer to the definition really well, I have culled out the extract of the relevant section. And let me read the section along with you. So you can refer to the green table at the bottom of the screen, which defines fee for technical service. So explanation 2 to section 917 defines fee for technical service as, for the purpose of this clause, fee for technical services means any consideration, including any lump sum consideration, for the rendering of any managerial, technical, or consultancy services, including the provision of services of technical or other personnel, but does not include consideration for any construction, assembly, mining, or like projects undertaken by the recipient, or consideration which is taxable under the head salaries. So the text in bold and underline is very important, and that in a way gives out the answer as to whether or not a particular service falls within the definition of FTS or not. Now, the point of view really is that as far as the E&P activities are concerned, which is extraction and production activities are concerned, which is perhaps the upstream activities, they should be covered in this exclusionary clause of the FTS definition, and more precisely in the phrase mining or like project. Now, this has been clarified with the CBDT back in the day in 1990, which was more like an instruction which expressed the point of view of the Attorney General of India back in the day to say that all the ENP activities would not be characterized as FTS, and to that extent, the relevant section should be Section 44BB. Now, this controversy really, had a lot of debate and a lot of heat between the taxpayers and the tax authorities since 2003. And finally, the matter, reached to the ITAT, to the High Court, and the Supreme Court also in 2015. And then we had the landmark ruling of the Supreme Court in the case of ONGC, which clarified and in a way echoed what the CBDT instruction provided for back in the day, that any ENP activity would not form part of the definition of fee for technical services, because there's a specific carve out available in the definition of fee for technical services. So at the cost of repetition, the Supreme Court ruling said that all ENP activities would be covered by the frame of words mining or like projects. And to that extent, since they are not FTS, the relevant section to go for is Section 44BB and not 44AD or 115 capital A. And this has, in a way, to some extent, in fact, to a larger extent, resolved the controversy. So as on today, the rule of thumb really works like this. So in case there's a service rendered by a non-resident service provider, the first test or the filter to check that whether 44BB is applicable or 44AD or 115A is applicable is that whether or not these services could be characterized as fee for technical services. Applying the ONGC ruling, in case of an ENP activities, you can safely presume that it is not FTS, and hence 44D and 115 capital is not applicable, and hence 44BB is the right section to go for. Now, this ruling of the Supreme Court has gotten a fair degree of acceptability at the field level tax officers. So this ruling came out in the year 2015 in the month of July, and almost 8.5 years have passed by since then. And we find a fair degree of consensus as far as the application of this ruling is concerned. So we had subsequent tribunal in the High Court rulings following the ONGC point of view. In fact, when we go for assessment proceedings before the tax officer, wherein the question of 44BB is sort of raised by the tax officer, whether or not Section 44BB is applicable, we more often than not cite the Supreme Court ruling, and they do accept the point of view to say that, okay, 44BB should be applicable to you, given the broad range of services which are covered by the Supreme Court ruling in the case of ONGC. In fact, even at the stage of determination of lower withholding tax rate, which is the 197 proceedings, we have had success cases wherein the tax officers have, without any reservation, accepted the Supreme Court ruling and gave out the lower rate of 4% under Section 44BB. So yeah, I think fairly resolved situation as on today. And the reason we keep on discussing as to why it is important to read the Supreme Court ruling, know about the contours of Section 44BB, is that Section 44BB provides for a fairly reduced rate of taxation, which is only 4% of the gross revenue basis, as compared to Section 115A, for example, which provides for an effective tax rate of almost 21%. So the swing of taxes are quite huge. And this controversy really is important to take care of, because many a times when the contracts are sort of submitted and there's a tax built-up clause that we are writing in that particular contract, it's very important to know that and be very certain that Section 44BB is applicable to you, because then you will be assuming a lower rate of 4%, and that in a way will make you competitive in the overall tendering process. I'll just take a pause here. Maybe Anuj, in case you want to add something, or maybe should we ask for questions on this point?
I think only for the audience to know that, as Gaurav just mentioned, the swing in tax or the difference in tax here is significant. We're looking at a tax of roughly, say, 4.3% for non-resident oil field service providers, vis-a-vis a tax as high as, say, 20% under the domestic law, which is a tax applicable on fee for technical services. And if you were to just paint this in an example, say there's a French non-resident service provider, which, for example, ONGC or Reliance, which are operators of oil block who have signed up contracts with the government, they reach out to non-resident service providers, say for a seismic survey or a geological surveys to be done on oil blocks. Now, when they do those surveys, examine the findings, give results on possibility of existence of oil or gas in those blocks. Now, there could be different situations. While some of the activities could be done remotely outside India, well, some minor presence may still be required in other cases. Now, regardless of taxation under 44BB, there could be other provisions under the law, under the treaty that could come and play here. Now, the swing in taxation is significant. You could look at taxation as FTS now under the domestic law after the increase from 10 to 20%, as high as 20%, from 4% to 20%, or as high as 10% under the treaty. And where there is a PE, then the tax could be as high as 40% on net basis. So it is absolutely important that we look at this provision with most diligence, ensure that the benefit is protected if that benefit is to be allowed or is to be available, because there are not a lot of provisions now in the tax law which offer as low as 4% tax rate for non-resident service providers. That's the key, and that's the importance of this provision in the tax law. Gaurav, back to you.
Right. Yeah, that's right, Anuj. And maybe moving on. So what I have done is that pictorially depicted as to how the flip-flop or maybe the controversy is really shaped up. So section was introduced in the year 1983. The first 20 years, there was no controversy. Both the taxpayers and the tax authorities were on the same page. Taxpayers, they claimed the benefit under Section 44BB, which was accepted by the tax authorities. The problems, they started from year 2003 onwards. And the reason was, in the year 2003, Section 44DA was in a way introduced, which in a way motivated the tax authorities to start raising questions to the service providers to say that now henceforth Section 44BB is not applicable, and then you should be resorting to Section 44DA. And the reason was simple, because Section 44DA in a way yielded more tax as compared to what tax authorities earned under Section 44BB. Now the controversy went on and on. So there was also an amendment in the year 2010 in the Section 44BB itself, wherein it said that 44BB would not be applicable in case 44DA is applicable. So that gave out more horsepower to the tax authority to then aggressively more question the point of view adopted by the taxpayers. Finally, we had the OHM ruling in 2012, which in a way brought out a ray of hope, gave out a point of view that Section 44BB, being a more specific section to an E&P service provider, should be obliged and followed in real life. And then we had the landmark Supreme Court ruling in case of ONGC, which in a way fortified or cemented the position that 44BB is the section to go for as far as the E&P activities are concerned. And after that, since last maybe 8 years, the point of view has remained the same on this fundamental aspect of eligibility of Section 44BB. And we are hopeful that this point of view really does not get overturned in the future, because if it does, then it creates a lot of problem for the non-resident service provider, and may not really bode well with the overall growth story that we have in mind for India, because this would really then dampen the investments that are happening in India. With that, I think let's move to the next slide. So while we have broadly discussed that, fundamentally, when is Section 44BB applicable? But as is the case with any other tax regime in India, there are few teething issues always. There are few other controversies that one needs to bear in mind. So as simple as what happens to reimbursement of expenses. So let's again take an example wherein ONGC or the Reliance, so they have a PSC with the government of India, and they engage a non-resident service provider, for example, a French service provider, for rendering of certain services. Let's suppose rendering of seismic service. And for rendering that particular services, there could be a clause around that whatever custom duty is sort of paid by the non-resident service provider, sort of recovered from the non-resident service provider, would be reimbursed by the Indian company, which is the ONGC or the Reliance. And the question really is that when this reimbursement happens for the tax component, what is the implication under Section 44BB? So do you include the tax amount? Do you not include the tax amount for the purpose of computation of gross receipts? And the better view is that you don't include the custom duty amount. And the reason is that because this particular amount is something which is not paid directly to the non-resident service provider, but in a way is ultimately recovered by the government of India. Because this is not an amounts payable under Section 44BB, this should not be added to the overall gross receipts under Section 44BB, and hence it's a positive point of view that really comes into play. And this point of view has been upheld by multiple High Court rulings, including the Delhi High Court in the case of Schlumberger. Now there could be another clause in the relevant subcontracting arrangement wherein let's suppose the non-resident service providers they end up incurring mobilization or demobilization expenses. So at a concept level, mobilization, demobilization expenses refer to the expenses incurred by the non-resident service provider for transportation of maybe a vehicle or an equipment or resources from point A to point B for rendering of services. So more often than not, we have seen that the subcontracting arrangement includes a clause wherein the operator undertakes to reimburse the amount of such expenses incurred by the non-resident service provider. And the question again comes to us is that what happens to this reimbursement? Whether or not should we include this amount for the purpose of computation of gross receipts under Section 44BB? And the answer is a negative. The answer is that this is still an amount which is payable to the non-resident service provider, although non-resident service provider may not really charge a markup on it. But because the amount really flows to the pocket of the non-resident service provider, it should be added for computation of gross receipts in the Section 44BB. And on that particular gross receipts, which is the inflated one now, the rate of 10% profitability rate should be computed for. Now, this point of view has been affirmed by the Supreme Court in the case of Setco Forex in last couple of years. So this is again a fairly settled issue as of today. As I said, the simple tax regime under Section 44BB provides an exemption from applicability of MAT. And the reason is very simple, is that they want to enable the ease of doing business for a non-resident service provider and not create hurdles in terms of application of MAT. In fact, this point of view was very well clarified by the CBDT in one of the budgets in the year 2019. And this is where the situation really stands today. Another interesting point is whether or not you apply Section 44BB to a second level subcontractor, so which is a subcontractor. So again, taking the same example which we took a short while back. So ONGC has a PSC with the government of India. ONGC appoints a subcontractor, a French service provider for rendering of geological surveys. French service provider, while has the most of the capacity, may not have the competence to do some bit of the work, and French subcontractor would then appoint a second level subcontractor, maybe a US subcontractor. So the question is that while in the first level subcontractor, Section 44BB would be applicable, would Section 44BB be also applicable for the second level subcontractor? On this, a better view is that yes, even for the second level subcontractor, Section 44BB should be available. And the reason is very simple. And we rely again on the Supreme Court ruling in case of ONGC to say that till the time the second level subcontract is in pith and substance the agreement which is in connection with the E&P activity, Section 44BB should be applicable. Because when you look at the wordings of Section 44BB, it does not refer or maybe discriminate between a first level subcontractor and a second level subcontractor. So the benefit of 44BB ought to be available to any number of subcontractor till the time you're able to prove the proximity of the nature of work under that particular subcontract with the main nature of E&P activity. The moment you're able to establish that, Section 44BB would be applicable to that particular entity also. In fact, we have multiple, tribunal rulings on this point of view. In fact, in one of the rulings, Anuj and I had represented the taxpayer before the Delhi ITAT, wherein we were able to get a relief on this point. So definitely a point of view that we typically abide by and we typically follow in real life. Another point is a minor amendment that was brought out by Finance Act 2023, last year. And the intention of the amendment was really to plug the tax practice followed by the taxpayers. So what used to really happen is that, let's suppose in year one, the taxpayer used to create the books of accounts in India and get the same audited and all, have a loss computed. In year two, they would determine the profits on a deemed income basis. So not prepare the books of accounts in year two. They would create a presumption that they are falling under the first subsection, deemed profitability at the rate of 10%, and then set off the losses from the last year against the deemed income in the year two. Now, this led to a lot of loss of tax and a lot of loss to the government exchequer. And to be very honest, seems like a very clever tax planning that any taxpayer can maybe resort to. This was finally noticed by the government, and the government sought to block this particular lacuna by way of an amendment in Finance Act 2023. So now the rule of thumb really is that while you can do this flip and flop to say that for 1 year you create the books of accounts, in year two you can maybe follow a deemed profitability, in year three again you can create the books of accounts, and so on and so forth. But the eligibility to claim a set off of losses in year one in which you create the books of accounts is not possible in year two, wherein you are offering income under the presumptive taxation. Last 2 points on the screen are perhaps like very general points. In fact, to some extent, they are sector agnostic points and impacts all the important players. But because oil and gas industry is a very strategic sector that we have in India, and hence it's very important that we also discuss those points. So you would know that a typical oil and gas contract is a very intensive contract in terms of funding, right? So overall, the ask is to get more and more funds, more and more funds from foreign resource or maybe an Indian resource, and then in a way apply that funds in the execution of the contract. Till last year, till June 2023, there were a couple of sections in the income tax law, which is Section 194 LC or Section 194 LD, which provided for a lower rate of 5% in case of interest earned by a foreign company while granting this loan to an Indian company. This section, however, has now lapsed while there were expectation and a lot of lobbying done by oil and gas companies to reinstate or maybe renew the expiry date of that particular section, but that unfortunately did not happen. And as on today, that concessional tax regime for interest payment received by a foreign company is not available. Well, again, I think what we really know is that, again, there's a lot of lobbying going on currently with the budget coming out in next 7 or 8 days to reinstate this particular provision in the income tax law. But we really don't know what would really happen. So we're keeping our fingers crossed and would really hope that, this really happens, because the moment 5% tax rate is reinstated in the law, it really brings down the cost of finance from, let's suppose, 10 or 15% to 5%, and would really, work well with the overall investment in this particular sector. The last point, again, is a very interesting point and very close to our heart, because we were really deeply involved in the development of this particular ruling. So this is the Nestle ruling of the Supreme Court that came out in October 2023. As I said, this is a sector agnostic point, applies to each and every foreign company, but also applies to various oil and gas service providers in a big way, because we have seen these non-resident service providers avoiding taxes, or maybe planning their taxes in such a way that their overall tax structure is really optimized. So the Supreme Court ruling which came out in October 2023 was really around how do you interpret the most favored nation clause in the tax treaty. So for all of you, and maybe at the cost of repetition, MFN clause in a tax treaty refers to the possibility of import of a lower scope or lower rate that a country has entered into with a subsequent OECD country, and basis that particular clause, there is a possibility of importing of that lower scope in the first treaty. So maybe explaining that by way of an example, let's suppose India-France tax treaty has an MFN clause. There is another treaty that India entered into, let's suppose with Portugal or UK, wherein a lower scope, lower rate was agreed. So for example, the treaty with India and Portugal had a lower scope in terms of fee for technical services. Now, the tendency of the taxpayer till now was that They used to say that because of the MFN clause, which is there in the first treaty, which is the India-France tax treaty, they used to import the lower scope from the India-Portugal tax treaty and then claim a lower tax or a no tax position. Now, this practice of the taxpayer has been put to a stop by the Supreme Court. Supreme Court very clearly held that this is something which is not permissible unless and until there's an express notification by the government allowing this particular treatment. Now, there's a lot of hue and cry in the international tax community as to whether the ruling is right or ruling is wrong. But unfortunately, because Supreme Court is the law of the land, this is what the point of view really stands today. So as on today, let's suppose a non-resident service provider who did not have a PE in India wants to take a view that because of the MFN clause in that particular treaty, say India-France tax treaty, they don't, in a way, warrant paying taxes any taxes in India. I think that has been really plugged by the Supreme Court ruling. And to that extent, I think one needs to really see as to what happens in future. Of course, as on today, we have the beneficial provisions under the income tax law as well, which is the Section 44BB that would be really applicable. But definitely, it in a way increases the tax cost for the non-resident service provider. So I'll just take a pause here. Maybe Anuj, you want to maybe share some practical insight as to how companies are reacting to the MFN ruling, or maybe any other point that you would want to share.
Sure. And just to put the last point in business perspective, you look at, we spoke about difference in tax rates, 4%, higher rates of 20%, 40% on net basis. And there was also a possibility where 4% could have been optimized to 0%. And how is by resorting to the tax treaty, through using a most favored nation clause, which is a very specific international tax concept, which works on say parity basis or non-discrimination, so to say, where say if a particular treaty is signed up, has XYZ provisions, if another treaty is signed later in time, say an OECD country which has beneficial tax provisions, then XYZ provisions can be read down, beneficial provisions can be read into the first tax treaty, which goes on to mean that the tax rates could be lower, the definition allowing the scope of taxation could be read restrictively, such that only a particular set of services, not all services, will be taxed under the treaty. Now we're looking at seismic service activities, say, which are done entirely offshore or really outside India. Then there was a possibility that non-resident taxpayers could have taken a position that those services are not liable to tax in India under the treaty by resorting to this very unique most favored nation clause. Now, because that is read down by the Supreme Court, that possibility is limited, far limited now. And therefore, we're looking at a tax rate in the context of oilfield services likely to be around 4%, regardless of whether these are services performed from India or they performed outside India. I think, Gaurav, with that, you can move to the next two segments. They should not take time. They're pretty, I think so, general, right? They're par course.
So for both midstream and downstream, we do not have like very big bang sort of a provision within the income tax law, which is sort of available to any E&P player. So as far as the midstream goes, there is an incentive which is available under Section 35 AD of the Income Tax Act, which says that 100% of the capital expenditure incurred in laying and operating a cross-country natural gas, crude or petroleum oil pipeline would be available as a deduction to that particular entity expending the amount. The other provisions of the income tax law, which is the normal income tax rate and disallowances under Section 43B or 40AI, that would remain to be applicable to that particular midstream player. And yeah, this is what it is for midstream sector. We can quickly move on to the downstream sector as well. And again, when we look at the series of provisions that we have, and in fact, starting from 2014 till 2020, we have seen like an individual provisions being inserted in the income tax law, which says that income earned by a foreign company or an Indian company is exempt from tax, subject to satisfaction of certain parameters here and there. But again, when we look at the gamut of players to which these sections really apply, these are not like a very big list. These sections were introduced in the income tax law pursuant to maybe a lobbying by a separate or maybe a very specific taxpayer. So, for example, the first point which is there on the screen, which in a way exempts income earned by a foreign company from sale of crude oil subject to certain conditionalities. This was introduced in the income tax law because of Abu Dhabi National Oil Company. So they had entered into an agreement with the government of India on this perspective. And just to incentivize their investment into India, this particular section was brought in the law. Similarly, we had 1048A, 1048B, around as to what are the income tax incentive from storage of crude oil. But again, this in a way ends up impacting only one taxpayer, which is the Iranian oil company, and does not really in a way impacts all the other E&P service providers. The latest in the list is the 2020 amendment, wherein with an object to improve or increase the overall reserve of India, a specific exemption to Indian Strategic Petroleum Reserve Limited was brought in. This ISPRL is a wholly owned subsidiary of Oil Industry Development Board and works under the aegis of Ministry of Petroleum and Natural Gas. But again, I think this particular section does not in a way generally impacts all the other downstream players. And similar to the midstream players, the general provisions of the Income Tax Act would be usually applicable, and that those particular sections would need to be observed in toto.
Yeah. And particularly the last point, I think it was strategically introduced in the tax law around COVID when there were geopolitical tensions. Just for energy security, the government felt need to create adequate reserves in the country, such that because of those geopolitical tensions, if we should have really crude in abundance, so as to control inflationary measures, which really we felt Europe really bore the worst part of it. Just for a better secured energy mix, this provision was introduced so that there are adequate reserves of crude in the country, which crude reserves are unnecessarily supplied locally in the Indian market for this tax exemption to apply. It's particularly a very, very targeted exemption that was introduced. Got it back to you. I think the last slide, really time check.
And you made a very good point that geopolitical tensions, they lead to the way the government really reacts.
Yeah.
And the first point that we have on the next slide, that the government introduced the windfall tax. So windfall tax, guys, at a concept level is something that is sought to be levied by the government with respect to certain activities which is not in a way is done or controlled by the relevant taxpayer. So the example that Anuj took of geopolitical tension, that was perhaps the reason why this particular windfall tax was introduced in the Indian context. So we had the Russia-Ukraine war, which in a way led to a lower supply. A lower supply of crude oil would really mean that the overall price of crude oil really, skyrocketed. And this in a way indirectly benefited the Indian companies, to be it IOCL or BPCL, who had the stock of those oil with them. And this led to these entities earning super normal profits. So government caught them right in time, introduced the windfall tax. And windfall tax is usually a certain amount per ton of crude oil that is sought to be levied. And again, it's not a fixed number that government really puts under the law. This is a number that keeps on getting revisited every fortnight. So it may go up, it may go down, it may completely be vanished, and so on and so forth. But again, just to be making sure that we understand this better, this is not like an only India phenomena. We have countries across the globe applying windfall tax to their taxpayers. So UK does that. They call it energy profit levy. So perfectly ethical, perfectly okay, and perfectly helps government to garner the relevant expenditure that they want to maybe take care of. So from indirect taxes, I think windfall tax was the first and important point that we wanted to share with you. The other elephant in room in such context is the inclusion of oil and gas products within the GST ambit. So when you take up an E&P player, typically, and when they're dealing with oil and gas products, so there is no typical GST output liability because petrol and oil and gas products are not covered in the ambit of GST. But definitely there is an input GST credit in terms of whatever services they typically source from. They need to maybe discharge the GST there. And to that extent, because of this disconnect between the no output GST liability and the GST input liability, there is definitely a cost that builds up at the entity level, and which in a way increases the price of that particular product. So the long-standing ask of the government really is to have these products within the ambit of GST, just to make sure that there is an efficient offsetting happens, there is no cascading effect, and there are no tax inefficiencies in the system. A related point really is that the moment you say that some bits of the products are covered under VAT or excise on the output side, but on the input side, there is still a GST impact, the players would inevitably require to be complied with both the laws. And to that extent, this increases the compliance burden of that particular player. And this in a way only adds up to the administrative burden of the taxpayers in India. So the moment this oil and gas products, they are covered within the ambit of GST, this problem should also go away. And in fact, this would in a way help to improve or optimize the overall ecosystem of oil and gas, and would yield greater results. Now, this has been the ask of the relevant industry since so many years now, almost 6 years now. There are promises made by the governments in the past discussions that this would happen in due course, but unfortunately, this has not happened. But yeah, the oil and gas players, they keep on asking for this particular request, and we are hopeful that sooner than later these products would be covered within the ambit of GST, and things should fall in place the right way. The last point is typically when the natural gas supply really happens, there's also a transmission charge levied in a bundled manner, because the natural gas is not subject to GST and subject to VAT. The VAT is applicable in the overall price, including the price of transmission charges. So there is a VAT hit there, and inevitably there is a GST levy of the transmission charges on a standalone basis as well. So again, a case of dual levy of tax on the same transaction, which is again not very desirable, not a very healthy way of looking at things. And we are again hopeful that the moment the oil and gas products are covered within the ambit of GST, these teething issues and these procedural issues will be taken care of in a very automatic manner. So this is where we pause, and I think this is all what we had to maybe cover in today's presentation. Arijit ji, we can open the floor for question and answers if you want, and unless Anuj, you want to make some final
No, I
comments.
think we're good now. Arjit, if you have any questions, or if you think there are questions that have popped up, or if you think in the interest of time we need to get back to the audience with written responses, we could do either ways. Let us know.
First of all, I must say thanks for your very well presentation. You said in the starting that degree of temperature was 8 and your thought was not good. For more than 200 participants was continuous for a whole session. So it's really a good clap to both the speakers. And I must say an appreciation to the committee who has taken this topic very well. And there are a lot of questions from the participant side. And I would like to ask one question, first question. They are asking that is there any tax incentives or a tax haven place? Like you have mentioned, some Kaveri, they have researched it. So is government is giving any tax exemption or 100% allowance to some place where some entrepreneurs do research activities?
Yeah, so nothing in terms of research, but there are incentives, Arijit, that you mentioned. Those, and I think incentives can take through various ways, right? They can either be through monetary or subsidies, like we have in case of production linked incentives. But here, I think some of the incentives that exist in the tax law, they exist through a lower taxation. And these lower taxation are some of the incentives Gaurav spoke about, like a 4% tax rate for non-resident service providers, like a lot of deductions that are allowed in the contract for oil operators, accelerated deductions, 100% of capital costs. I think what we mentioned about discovery in Krishna Godavari basin, really near the coast area of Andhra Pradesh, that is a discovery that has been done by ONGC, where there is a profit share to be paid to the government. So the taxation for those operators are done in a particular way where there are deductions in terms of expenses. More and more expenses are allowed. They're allowed in an accelerated manner. which in a way helps them reduce their taxable base. And of course, naturally, the tax that is worked out is lower. So there are incentives applied differently from a tax standpoint. I think, yeah, so that is how government is looking at this. But I think to answer your question, incentives do exist. Not only incentives, the government has opened the sector to 100% FDI. So oil exploration, oil refineries are open to 100% FDI. So it is a red carpet really that has been put out by the government for foreign investors to come and invest into India and really have this important sector contribute to other connected sectors and segments in the industry.
And well, to supplement what Anuj said, and Rajit, I think you raised a very valid question, right? So in our latest publication that we have released, and we have written a letter to the government as well, we are asking for more R&D incentives as far as the midstream and downstream sector really goes. Because these things are really important in order to make sure that taxpayers are very well incentivized and in a way helps to have more and more players participate in this particular sector. So we are again keeping our fingers crossed that government comes back with some incentives the way it was the case maybe a couple of years back, just to make sure that we have the momentum going on the way it is going on.
So the next question is how you will differentiate between an allowed expenses and a disallowed expenses. Like in every business, if I ask in a general business sense, like bribes and all, that is being a disallowed expenses. You have mentioned in one of your slides that out of 10,000, 6,000 will be allowed and 4,000 will be disallowed or carry forward. So how you will differentiate or say that this 4,000 will be a disallowed expense?
Okay, I think
Or
the
you can
question
list
was,
out some examples.
Yep.
yeah,
So I can take up that question, Anuj.
yeah, Gaurav. Yeah, makes sense. Go ahead.
So that's right, Arijit ji. And just to maybe very answer that question in a very summarily manner, the other provisions of the Income Tax Act, which is, for example, Section 37 disallowance on account of bribe
Yeah.
that is sort of paid off, that needs to be factored in while determining that amount of 6,000 or 4,000 that we are talking about. So as far as the amount of 4,000 is concerned, which was perhaps in my example, the amount already claimed by the taxpayer, these adjustments would be factored in there already. So very easy to pull out that data. As far as the amount of 6,000 is concerned, there has to be some estimation worked out with the taxpayer there, cannot be foolproof. And to that extent, you are right. There exists some procedural problem in terms of, determining the exact amount to be considered for this purpose. I hope that answers the question.
Sure. Next question is there any pre and post expense like we have in section 24 income from house property, like pre-interest we have an exemption of 150 for the next 5 years, like this in this oil and gas also there is some provisions.
Yeah, I think
Because
the
in the
reference is,
initial year
yeah,
there is-
yeah. I think we get the drift of the question, Arijit. So I think, yeah. So pre and post in this context could be in the relation to, say, commercial discovery. When the exploration takes place, there could be some expenses pre-commercial production, some expenses incurred post-commercial production. Now, Section 42, which is the code determining profits for oil field operators, read with the production sharing or the revenue sharing contract, some of the expenses incurred before commercial production are allowed. And when I say are allowed, they mean they're deductible. Other expenses are not deductible, or they are deductible after commercial production. So this is what we mean when we say some of the expenses are deductible pre setup of business, some are deductible after setup of business. Uh, and therefore the date of setup of business, which is the date when the commercial discovery of oil or gas take place, that is a key threshold date to determine from which date onwards expenses should be deductible and in what manner they should be deductible.
Perfect. In one of your presentation, you have mentioned geopolitics profits to this Indian company. So is there any tax exemptions for this geopolitics? I understand that more than 25,000 crores was earned because of this Russia-Ukraine war by the Indian government.
Yeah, so I think a very short tax answer. not to divulge, but yes, I think it was done with a particular interest for the country. Uh, when the prices were very volatile, really, and in the interest of energy security, we wanted to have adequate reserves in the country, and therefore we had that situation where we wanted to create reserves, incentivize creation of crude oil reserves in the country, which is why tax exemption was offered. The connected point which Gaurav spoke about on windfall tax is a tax which I think is in technical terms called a special additional excise duty, which the government reviews on a fortnightly basis. Now, because say for oil refiners, oil downstream players in the country, they import oil, they make petroleum products, they export petroleum products. So there's a lot of import exports involved in the process. Because say for example, 1 barrel today is $80, which price changes very, very frequently. Now, because of this price volatility, there are situations where, say, oil players in the country make supernormal profits, which is why government really calibrates this levy of windfall tax on a fortnightly basis. So I think the statistics you spoke about could be true, but it was done with a particular motive and that motive was the interest of the nation.
Yeah, and only to add there, while Russia-Ukraine conflict was one of the instances wherein this windfall tax really, gained traction and all. Back in 2022, when the world again came to normal after the COVID restriction, there was a surge in the tax in the demand for the oils and all. And because of that, the downstream entities, they end up earning supernormal profit, and government was kind enough to come out with a windfall tax to have its own share in the pie. So there could be various reasons why windfall tax is there in the regime, and it seems that government from time and again would keep on levying this windfall tax as and when they see that there is a scope to recover taxes.
So asking the last question because our next speaker is also has joined, and all the other questions I will give you on a mail so that
Sure.
they can be transferred. So you have mentioned that books of accounts should not be maintained for this deemed profit. And if for the first year, if you are maintaining a books of accounts, then allowance and disallowance will be there. And for the next year, if you are going for a presumptive income, then the previous year loss will not be adjusted. So practically, is there any possibility that first year there will be a books of accounts and another will be a presumptive? Generally, I think because of this, every year there will be books of accounts concept. Is it so?
So that's right. And let me just try and clarify. So books of accounts need to be prepared from both corporate law and tax standpoint. So in case, let's suppose there's a foreign company having a presence in India, for example, they have a project office in India, there would be a requirement to maintain the books of accounts from a corporate law standpoint. The question around non-maintenance of books of accounts, which is there in section 44BB as an exemption, that is only in context of tax. So the moment somebody wants to go for a simplified tax regime, there is no need to get a tax audit done and directly claim the lower profitability of 10% in its return of income. Now, typically, to your question, Arijit ji, as to how typically a player in a way conducts itself on a year-on-year basis. So good possibility that in the first year they maintain the books of accounts because they have a perception that they would be earning a profit which is lower than a 10% deemed profitability rate, and get the tax audit done, determine the losses. Then maybe go in the next year. Next year, let's suppose things change, perception change, business plan change, and then they perceive that they'll be earning a profit more than 10%. So in that case, they'll surrender themselves to the deemed taxation regime, which is there under section 44BB, not go through the pain of getting a tax audit done. That said, there still would be a requirement to maintain the books of accounts from corporate law standpoint. And this is how typically they'll conduct themselves on a year-on-year basis. Only an addendum, and just to clarify as to what would happen from an adjustment standpoint. So in the first year, there could be adjustment on accounts of 43B, 40AI, and 37, and so on and so forth, because the taxpayer is maintaining the books of accounts in India, doing the tax audit. The computation of income happens on a net income basis. So they'll need to honor all the other provisions of the Income Tax Act. But the moment the taxpayer goes to the second year, surrenders itself to the deemed profitability regime under Section 44BB, there is no requirement to do any adjustment under, let's suppose, 43B or 40AI, 37, and so on and so forth. And the reason is quite simple, that the deemed profitability regime under Section 44BB is a notwithstanding tax regime. It overrides all the other general provisions of the income tax law, which in a way covers these adjustments also. So slightly longish answer, but I just thought to clarify that bit a little more.
So really a perfect and a very well answered. And I think there are few questions, but due to time constraint, I will request the committee to forward the questions to you so that you can
Sure.
answer and then they can forward to the participants.
Makes sense.
So
Yeah.
at the end, I will say thanks to both the speakers for a very well orating this topic and all, and give a vote of thanks to both.
No, thank you, Ajay. It was lovely to be here. You did a great job in moderating this session, and thank you to the audience for staying with us for so long and for asking very difficult, very interesting questions. Thank you again. We'll drop off. Thank you so much.
Thank you, Arijit ji. Thank you, everyone, for joining the Saturday morning session. And Anuj and I will be more than happy to help you on any tax issues. Feel free to reach out to maybe Arijit ji or directly to us so that we are of help to you. Thank you. Have a great day. We'll just drop off.
Recording in progress.
So I welcome our next speaker, Ashish Jain ji. He's a chartered accountant with over 2 decades of work experience in the areas of assurance, audit, risk management, forensic, financial control, governance, and compliance. He's currently serving Navya Energy as a Chief Internal Audit Officer since the last 5 years. Nayara is one of the largest refining companies in India with a revenue of over USD 15 billion and more than 6,000 retail outlets pan India. Prior to that, Ashish served Shell upstream business as head of audit and governance for India and Southeast Asia. He served Shell for 10 years, and prior to that, Ashish worked for organizations such as Total India, Mahindra, Godrej, Birla Group, and Philips India. Ashish is also serving as a board of governors at the Bombay chapter of AIIA India. So, with this, I welcome Ashish ji for his deliberation.
Hey, thank you so much, Arijit, and really honored to be part of this excellent webinar that has been organized by ICAI. And also a big warm welcome to all the participants in this session. So first of all, I would like to check if my audio is good enough for the people to hear. And then I'm just trying to share my screen. So would like to just know if my screen is visible on the...
It's visible, sir.
Okay,
and you are
fine.
most audible.
All right, perfect. So, thank you so much for participating in this session. And before I get on with the specifics of the assurance elements in the oil and gas sector, I would just like to maybe touch upon a couple of things regarding the oil and gas sector. Before, generally speaking, it's not a sector where people have wide knowledge or understanding about the intricacies of how this sector is operated and managed. Though, of course, it remains in the news for various reasons. But at the same time, as chartered accountants, it is really important that all of us have a basic knowledge an understanding of how this sector operates. The reason being, it is the backbone, it is the primary sector of the economy. The whole global economy is based on the price movements of the crude, oil and gas, and the energy products. And India, of course, is the third largest consumer of hydrocarbons. It's a growing economy, and therefore there is going to be a significant investment as well as consumption in this sector. And obviously, therefore, as finance professionals and as audit professionals, there is a substantial role that all the chartered accountants will have to play. They continue to play, and they will continue. I mean, they will obviously be expected to play in the future. So that's the context. So with that, let's start with a broad understanding of what is the value chain of the oil and gas sector, because it is a huge sector, and unlike other sectors where you wouldn't really have value chains, this is an industry where every sector has its own peculiarities, has its own risk profile and challenges, and therefore you would find that very few companies in the world have a presence across the value chain, and mostly you would find organizations focusing on either one or two of the subsectors that this sector basically entails into. And so the first and the primary most sector or the subsegment of the industry is exploration and production. And this basically is the main and most important part of the oil and gas, because if you're not able to identify and not able to then commercially produce hydrocarbons and bring it to refining, basically there'll be no possibility of having a sustainable source of energy. And therefore, the exploration and production value chain is the most important segment in the entire oil and gas. And this, therefore, by far remains the biggest risk as well as biggest capital intensive part of the oil and gas sector. Now, in the Indian context, I will come in the next slide. But essentially, the exploration and production is also called as upstream sector. And there are two key elements that are actually involved in this particular subsector. The first is the identification of the oil and gas reserves, and that is essentially the exploration and appraisal of the reserves. And the second is the commercial production of the identified reservoirs. So this is basically what this sector does. Once you have the crude, and there are at least hundreds and grades of crude across the world, and each of the crude has its own set of challenges in terms of refining. So therefore, refining is a separate value chain in the oil and gas sector. It again requires billions of dollars of investment, and it is a very, very complex activity. Though, of course, the process remains more or less the same across refineries in the world, but the technology that they use and the kind of products that they can then generate from the feed of crude that they use is significantly different. So therefore, there are significant challenges in relation to technology risk, in relation to the logistics risk in the refining sector. And that is why it becomes important to understand this sector also as a standalone business model. Now, essentially what happens is that there is a crude intake into the refinery. So either it is through ports, it is through pipelines, and then there is a refining complex where then the crude is refined into 15, 20 different grades of products. We largely know petrol and diesel, but apart from that, there are so many other products. We have petcoke, sulfur, the ATF, which is the airline or the fuel on which you have the aircraft running. You have kerosene, you have fuel oil. So there are significant products that are then generated out of the crude, and each of this has its own dynamics of pricing volatility and demand volatility. So therefore, a refining sector has to manage the volatility from the crude side, and then at the same time has to stabilize the market potential of the products, and then have to have the ability to quickly quickly change the product profile depending upon the economics of each product category. So that's the key challenge of refining. It usually operates at a very small refining margin, and generally speaking, because of the fact that at least in the retail segment, the prices are influenced, I wouldn't say controlled, by the government. Therefore, there is a huge risk in terms of the price realization as well. So that's the sort of background on the refining sector. And then the third and the most important, it's the last in the value chain, but again, the most important one. So this is the distribution and marketing end of the sector. Now, this basically involves investment in depots, pipelines, retail outlets, and then making sure that the last mile gets connected with the hydrocarbon chain. As we understand how the new energies are developing, whether it is electricity or hydrogen. Obviously, the marketing and distribution end will also significantly change, but at least till the time we continue to have hydrocarbon as a major component of our energy requirement, the existing infrastructure and distribution of the hydrocarbon will continue to have significant investments, and at the same time will place a very significant role in ensuring that we have availability of such energy at the retail as well as at the industry level. So that's the basic overview of the sector. And it's really important to understand the overview, because how the whole oil and gas sector is interdependent on the value chain and how it impacts the dynamics of the whole sector. That's really important to know. Moving on from here is the Indian landscape. Now, as I mentioned, India is the third largest consumer of hydrocarbons. But at the same time, the challenge with India is that it is not a major producer or the major extractor of oil and gas. So therefore, India is heavily dependent on imports for crude and gas. And that is where you see that India inflation is so strongly connected with the movement in the crude prices. And at the same time, there is a significant effort made by the government in attracting foreign investments in exploration and production in India. But for all and several reasons, ONGC, which is the public sector undertaking, and Oil India Limited. So these are the two major companies that continue to be doing the exploration and production in India. And I would say that almost 80% of the oil and gas produced in the country is contributed by these two companies. Apart from that, Reliance obviously produces gas from the KG-D6 in the east coast of India. And then there are a couple of marginal players who are actually present in the onshore of the production side, and that is basically in gas. Now, before we move on to the other segments, we have to understand that in India, there is onshore production, basically on land, as well as offshore production of oil and gas, which is basically in sea. And when I talk about sea, these are deep water as well as shallow waters. Deep waters could be as deep as 200 meters. And this is something which is, Indian subsea drilling is one of the most challenging in the world. So there is a significant amount of technology and capital investment that is needed in exploration. Unfortunately, in India, we do not have the required amount of technology. So we have to be dependent mainly on the foreign suppliers of technology as well as equipments. But if we see the exploration and production activities increasing in India, and if we find that there are significant reserves in the country, hopefully one day we would have a whole ecosystem of the service providers and technology providers in the E&P sector. So that's the major sort of landscape for the exploration and production in India. The entire hydrocarbon that gets produced in the country has to be mandatorily supplied to the local refineries. So no, at least till the recent past, nobody was allowed to export crude or gas. But now, very recently, the government has opened up open marketing of the crude, which obviously still is at a nascent stage. But given the fact that we have a significant deficiency, it obviously it will be very difficult to then import the requirement and then allow our local producers to then export the hydrocarbons outside the country. So therefore, the amount of government intervention, maybe to some extent, could be justified. The LNG space, I'll come later, but the downstream space is where you have the majority of the public sector undertakings. So almost 60% of our refining capacity in India is managed by the oil sector or public oil sector companies. This basically, so IOCL is the largest one, followed by HPCL, BPCL, and an MRPL, which is the subsidiary of ONGC. We also have significant private players in the refining space. Reliance, in fact, has the largest on-site single-site refinery in the whole world. And Nayara is also the largest private refinery in India with a single-site capacity. So that's the landscape for downstream. As I mentioned, the challenges of downstream are significant in India. The crude volatility is something that the refining companies have to manage. Again, majority crude has to be imported. There is a huge uncertainty in relation to the availability of crude. We've seen the impact of war and the geopolitical scenarios resulting in our ability to import crude from certain traditional suppliers. And then at the same time, the pricing of the products is not necessarily is a factor of cost. So therefore, majority of the time, there is a significant element of government interventions in the pricing for major products. So that's again where there is a significant risk involved in managing the balance sheet and profitability of this business. LNG is now emerging as a third vector in the oil and gas sector. So far, in fact, in last 15 years, India did not have any infrastructure in gas. And therefore, the consumption of gas in the whole basket of hydrocarbons was very low. But there has been a significant policy push by the government and participation by the private players to get into the gas space. So therefore, now we have significant capacities in LNG terminals. So what an LNG terminal does is that it facilitates in the importation of gas, and then it through pipelines supports in then the on-road distribution of gas. So that is where you have the Petronet, and then you have Shell, Hazira, and a couple of other LNG players in the country. GAIL happens to be the largest distributor of gas, so they have the largest pipeline network in the country. And then there are PSUs who have their own captive pipelines for the transportation of gas. So I would say that this is one sector that is going to grow exponentially in India. It's a huge sort of scope for development. We have city gas distribution, which is coming up in a big way. So there will be connection of gas to pipe network across India in the households. And then, of course, there will be more and more substitution of gas as an alternate fuel and comparison to traditional fuel which the industry uses. And therefore, to that extent, there is the requirement of investments and resources is going to be huge in building the pipelines, the last mile connectivity, and of course, in finding long-term contracts for gas supply across the globe, and then getting the LNG cargoes for importation, and then the infrastructure building in India for making sure that we have adequate storage facilities in India for the gas distribution onwards. So that's the overall landscape of the oil and gas sector in India. It is one of the largest sectors in India. Of course, there is always a challenge in terms of identifying the true sort of the level of investment, so the level of output of this sector. But at the same time, this happens to be one of the largest sectors in the country, and therefore, by a consequence of that, it therefore should be one of the biggest sectors which should attract chartered accountants to develop their competencies and build their career in this sector. So coming to now more specifically on the upstream sector, because as I mentioned earlier, that this is one sector that has the largest amount of risk and has the biggest requirement of investment in terms of building of infrastructure. So therefore, it is really important to understand the risk profile and the challenges of the sector, and then find opportunities where chartered accountants or auditors in general or assurance providers then can add value in the sector. Now, unfortunately, there is very little awareness and knowledge of those opportunities. And therefore, what eventually happens is that most of the companies in India have to then use support or has to use competencies or resources from outside India. And that is very unfortunate that we have such a huge talent pool in the country, and yet we do not have people with the required set of competencies who can then serve this industry. And likewise, there is a huge opportunity globally for chartered accountants to serve this sector, especially in the Middle East and in Far East and in the European markets, where again, I mean, there is a huge demand for people who could provide support and assurance in various elements in the value chain of the oil and gas sector, which we will cover. So today, let's focus on what challenges and what aspects of upstream sector through opportunities and how we can get a better understanding of that. So as I mentioned, business risks. Why I do say that business risks, because though the reserves of the hydrocarbon are actually the property of the host country, but the host countries or the governments do not take or do not assume any risk of investments and exploration of those reserves. So essentially what it means is that a company which is interested to get the mining lease and then to produce oil and gas from those reservoirs will have to take the entire risk of finding the, or for that matter, determining if there are reservoirs enough to make it commercial viable, and at the same time then to develop those fields. And then we've seen the volatility in the crude prices in around 2018 and 2019. The crude was as low as $20, $30 to up to last year where it was up to $100. And now it is again tapering towards $70, $75. So with that kind of volatility, and I think that is perhaps the most volatile commodity in the whole world, how do you make investment decisions which actually take 5, 7, 10 years to bring the project into production? So that's a very difficult decision to take because you will not know exactly, you will not be able to time the sector. And at the same time, you would either find a situation where there are too many facilities coming to production with peak crude prices, or you would find that there are there's a huge shortfall in availability or production of crude and prices remain high for a couple of years. And that is the mismatch that honestly is very difficult to build. And therefore the risk and obviously the reward, but majorly the risk sits with the upstream sector of the oil and gas. It is one of the most capital intensive sector. In fact, I don't think that there is any other sector that is as capital intensive as the upstream sector of oil and gas. So there is a huge cost involved in understanding the subsurface properties. So one has to get seismic data, which basically is a data that tells you whether there is availability of hydrocarbons, which is almost 100 to 200 meters below the surface. So there are technologies now available where we can know what is happening or what are the properties of on the surface, on Moon, on Mars. But till date, we have very little understanding of the geological part of the subsurface of Earth. And that because it is so capital intensive that perhaps it's easier to send satellites on other planets as compared to get the seismic information of the subsurface on Earth. So it is a very, very costly activity. And then once you get the data, it is very difficult to interpret that. So there are very costly softwares and tools available, which helps you to zero down what would be the, so for instance, there would be lakhs of kilometers of area. And in that, you have to zero down on, say, 400 meters or 500 meters of space where you can actually drill and see if there are reservoirs available. So it is that challenging, and therefore it requires significant amount of technology to interpret the seismic data that you get. And then drilling is a very costly affair. Onshore is comparatively less costly, but when you talk of offshore and you talk of that depth of sea, it is a very, very costly affair. Just to give an example, if you're talking of a subsea or a deep sea block, it could cost upwards of $100 to $200 million to just drill one exploratory well. I'm talking of 1,500 crores to 1,600 crores of just drilling one well. And you just do not know whether actually it will result into any meaningful discovery or not. So it is that capital intensive, and that is the element of risk involved. Coming to regulation, I think if there is one sector that is most regulated in the whole world, it is the hydrocarbon sector, because of the fact that the nation's security is dependent on energy, and this is the major source of energy. All governments in the world have kept this sector as one of the most highly regulated sectors. So from the point of the licenses needed for exploration, to the approvals needed to develop the fields, to the approvals needed for actual production, and then for the purpose of deciding the availability of those products and marketing those products, to the pricing decisions, everything is regulated. Again, this is one sector that has the most amount of taxes. I don't think there's any product in the country that is taxed that extensively as the petrol and diesel. So it is the most regulated country, and therefore most regulated sector in the country, and therefore it becomes very challenging for anybody to make a successful business in this sector. It requires huge investment, very long-term commitment, and huge alignment with the government to make sure that the policies remain stable and investment decisions therefore can deliver the results that were expected. The last but not the least is the environment impact. So needless to say that this sector has the largest footprint on carbon emissions, and therefore there is an increasing challenge in relation to how the carbon footprint can be reduced, what can be done to make sure that there is a lesser and lesser impact of CO2 on the economy and on the environment. So this is something that obviously the industry has to deliver significantly, both in terms of technology and in terms of investments in funding the green energy initiatives of the government. So this is the fourth sort of challenge that impacts the oil and gas sector in the upstream side. Coming to the key aspects of the oil and gas sector in the upstream side. So this is basically gives you a whole sort of a business cycle from start to finish of how an upstream field gets developed and produced and then ultimately decommissioned. So the start is from getting a mining lease from the government. So in India, you must have seen in newspapers that there are announcements. Earlier, it used to be called as NELP, which is National Exploration License. And now it is basically open acreage. So it is called OLAP, but it's just the change in the terms. Basically, what it means is the government invites the oil and gas players to basically bid for the mining leases for the exploration of oil and gas, and that's how it all starts. So there are specific bundles or the areas are earmarked, and then they are put for auction. And then companies like Shell, BPCL, ONGC, international companies, they do bid for these mining licenses. And then once the bidders have been selected, then there is a lease contract which then gets entered between the government and then the successful bidder of that lease. That then results into a mining lease contract, and the mining lease contract then essentially results into commitments being given by the bidder in terms of how they will do the exploration and appraisal of the fields that they have been given on lease. So there are time commitments, and then there are investments that needs to be brought in order to do the activity successfully. And in order to make sure that these are delivered, the government takes bank guarantees from these players. And if they are not able to successfully deliver their commitments, then the bank guarantees usually gets invoked. But that's the starting point of the activities in the upstream side. Usually, given the fact that there are significant investments and it also requires huge amount of resources, the most commonly used approach is joint venture agreements. So you would find that 2 or 3 companies together bid for the mining leases, or suppose ONGC may get the mining lease, but then once they secure that, they may actually try to get somebody as a partner so that they can then share the risk and capital commitments with the partners. So that's usually the model across the world that is followed in the upstream sector. And I will come to the part subsequently, but just to highlight that is one of the most important opportunities for assurance providers and auditors to provide services in relation to the management and operation of these joint venture operations. Once the mining lease is awarded and then the joint venture partners are on board, then the work starts, and the primary work is then to do the seismic surveys. And this basically, as I mentioned, is a very, very costly activity. So that involves special type of vessels which are required in case it is offshore. And these vessels then have to very systematically cover the whole lease area and bring in the records then which requires years and years to interpret. Sometimes the government does provide this data, but then that is at a cost. Likewise, the seismic data which the individual companies generate, that again has to be submitted to the government of India. So basically, the cost has to be incurred by these players, but the data still remains the property of the government. Once the analysis is completed and then different models are developed in terms of the probabilities of reservoir, then comes the stage of actually identifying the location where you need to drill an exploratory well. And that is where then you have to go back to the government, you have to submit the proposals. The government regulator, which is called DGH, Directorate General of Hydrocarbons, they have a technical experts. They will evaluate the proposal and then they will confirm that, yes, this is the best site to drill the exploratory well. And that's when then the first exploratory well is drilled to test the availability of reserves. And then once it is successful, and then once there is an in-place reserves, then a couple of appraisal wells are drilled to just quantify the in-place reserves, so that then a whole development plan can be built in terms of how many platforms, how many wells will be drilled, what will be the production from the field, how much infrastructure will be needed. So all that plan is built on the basis of the findings from the appraisal wells. So again, there are minimum commitments in the mining lease with the government in terms of the appraisal wells needed. And after the successful drilling of the appraisal wells, usually you would find companies making a declaration about the reserves that they have discovered. And they will have to then declare that if they're listed in the stock market, they will have to then get confirmation from the regulators in India, like DGH, of those reserves. And that essentially then becomes the sort of one of the key parameters to do valuation of these companies. So if you find most of the companies which are into upstream sector, like ExxonMobil, Chevron, BP, Shell, one of the major factors to value these companies is to see what is the in-place reserves. The reason why Saudi Aramco is one of the most valued companies in the world is because of the fact that they have significant amount of proven hydrocarbon reserves, which then gets valued based on the various models. So at this stage, the joint venture partners enter into production sharing contract with the government. So here, then the whole negotiation happens with the government in terms of what should be the cost that will be incurred to develop the facilities, build the infrastructure. That again has to be approved by the government. And then once the production starts, then there is a negotiation with the government about what will be the government share of profit after the production volumes are sold, and then what will be essentially the royalty and cess and a couple of other revenue streams that comes to the government from the production of that. So this is the most important part where then the production sharing contract, once entered, becomes binding on all the contractors, let's use that word from now on, who will be basically developing the field and producing the hydrocarbons from there. So once that is confirmed, once that's approved, then the development of the field happens. In case of a typical oil and gas field, you would have a major processing platform where you will be processing the crude and gas which gets extracted from several wellhead platforms. So for instance, there will be 6 or 7 wellhead platforms which will basically be used to drill the wells, and all the hydrocarbons that gets extracted from there will be first brought into the processing platform so that these can be treated, and then from processing platforms, then they are delivered at the delivery point to the buyer of those hydrocarbons. So therefore, typically a development plan will include all these infrastructure facilities. And then once that's completed, then the production starts. And usually the life of every field will be between 5, 10, 15 years, depending upon the reservoir and the speed at which the hydrocarbon gets extracted. And once the field achieves the full sort of life, then the liability of the contractors is to decommission and abandon that facility. So there is an additional cost, a significant amount of cost that has to be incurred to plug in the wells, to decommission the platforms, and then to hand over those sites and those leases back to the government. So this is the whole sort of a cycle of the upstream activities. And now we will cover how at each stage there are opportunities and there are huge requirements for assurance providers to add value in the ecosystem. So this basically clarifies a couple of terms which is used in the upstream sector. So royalty, so under the Petroleum Act in India, government is entitled to charge royalty on any hydrocarbon that gets extracted from India. And when I say India, the definition of India is not just the landmass of the country, but the continental shelf in the ocean. So there are defined boundaries in the ocean for the Indian subcontinent. So anything that gets produced from there, the government of India is entitled to receive royalty. And the quantification of that royalty is, one is it is in the production sharing contract, other is the government is entitled to raise notifications so that it can then keep its right to make any changes in the royalty or the cess on royalty. Up till now, the model of the development of hydrocarbon reserves was or fields used to be a cost recovery model. And when I say cost recovery model, what it essentially means is that the contractors would recover the entire cost that they incur in the development of the field and in the production of the hydrocarbons from the revenue that they generate by selling those hydrocarbons. And the government has to approve the cost. So the cost recovery can only be according to the terms set out in the production sharing contract and according to the approval given by the government. And then once the cost has been recovered, then the profit that remains from the revenue has to be then shared between the government and the contractors. So there is a formula, there is a mechanism that gets agreed between the government and the contractors as to how they would share the profits, which then remains after the cost recovery. And this whole gamut of calculation of royalty, computation of cost recovery, computation of profit petroleum, all these things requires to be audited, requires to be certified by the auditors appointed by the government, by the auditors appointed by the contractors. And therefore, this is a huge scope for auditors and assurance providers to provide their services. And there are firms which specialize in the understanding of these concepts and have a global expertise in terms of how these calculations are made. It may sound very simple, but these are very complicated activities because there is an interpretation of production sharing contract on various elements of cost and various elements of volume. And then there are significant international practices that has to be applied alongside. Sometimes there may be contrary views, sometimes there may be lack of clarity, and that results into lots and lots of assumptions and interpretations in the computation of these elements. And that is where then the assurance providers and auditors play a significant role in providing opinions or identifying and then providing solutions. So that's sort of the major element of scope where the oil and gas sector needs auditors and chartered accountants to certify. The other important area where I would say that there is a huge requirement and there is a huge expectation on assurance are in the review of the joint operating agreement, or I would say in the performance of the joint operating agreement. So as I mentioned earlier, that I would say 95% of the oil and gas fields in the world are operated through joint operating agreements. Now, the most important thing that needs to be understood here is that these are not registered entities. So this joint operating agreement is not through an SPV or through a registered entity, and therefore the share into this into such ventures are not through equity holdings. So these are basically through the joint operating agreements, the share of revenue and the share of cost is determined. And then the joint operating agreement itself is a governing and an operating document on the basis of which the joint venture partners operate. Now, this is the only sector, this is the only industry where you have this kind of a phenomenon where you do not have a registered entity, but at the same time it has its existence right from drilling, exploration to production to revenue generation, and then through various elements of compliance. Yeah. So each entity in the joint venture will have its own share of accounting, have its own share of revenue, will have its own share of cost. And therefore, it becomes extremely, extremely complicated to sort of do these kinds of accounting and recordings. Yeah. So this is where then the role of chartered accountants and assurance providers come in a major and a big way. So the joint operating agreement basically comes with all the terms and conditions and all the covenants that is getting agreed between the joint operators. And essentially each operator, so for instance, any field would have 2 to 3 or even 4 joint venture partners. And out of those 4 or 5 joint venture partners, there will be one entity which will be the operator. Say, for instance, where Reliance is managing the KG-D6 blocks, Reliance is the operator, but then they do have other partners like BP and a couple of other partners who would remain as a joint partners, but they would not be the operators. So what essentially happens is that those joint partners will have their own assurance providers who will then review the operations of the field management, the revenue generation, the cost management, and then they will evaluate whether the manner in which they were apportioned the revenue and they were apportioned the cost has been done according to the terms and conditions of the joint operating agreement. And here we are talking of billions and billions of dollars of cost and revenues. And that is where I would say that there is a huge scope for support from chartered accountants and assurance providers, because this is not a regular audit. This is not your statutory audit, and this is also not your internal audit. This is essentially looking at how the joint operating agreement has been complied by the operator, and then how the costs and revenues have been apportioned between the joint partners. And this basically, therefore, takes us to understanding of some very important concepts in the management of the joint operating ventures, and at the same time, in terms of the management of the records. So there is no entity here. So therefore, there is no books of accounts. There is no balance sheet for these operations. Which, I mean, if you hear for the first time, you will really be rattling your head that how is it possible that you could have, $5-10 billion of revenue, but no books of accounts in terms of profit and loss and balance sheet. So what you essentially have is just the trial balance and just the listing of activities. And then from there, you build these records. So the first and the most important one is the work program and budget. So this is prepared at the start of the year. The operator prepares these work programs and budgets, takes it to the joint venture partners for approval. Then once that is agreed, then it goes to the government, the DGH for approval. Once that's approved, then that becomes the binding document, which means that the operator cannot spend even a cent more than what has been approved. So the first and foremost area of audit is to basically see whether the budgets have been approved, whether the activities that have been listed in the budget are adequately described, whether that then can be actioned. I mean, to the extent that it can be reviewed for performance and actions, and then whether the specific details in relation to the cost assumptions, in relation to the volume assumptions have been laid down, so that then there is enough transparency in the development of those budgets and work programs. The second stage is then authorization for expenditure. So the operator of these fields will have to then prepare statements every month, which are called authorization for expenditure. So this basically lists down all the activities that are expected to be performed, and the listing of the cost associated with those activities. And those statements then have to go to the joint venture partners and to DGH, and those have to be approved by the joint venture partners before those can be incurred. So this again is a significant activity, requires significant amount of due diligence and review, because first point of check is to see whether that was in alignment with the budget and the work program, and then to see that whether that's something that is really needed, whether that's been approved for performance by the operating committee of the joint venture. So that's again a significant scope of assurance and review. Once those AFEs, authorization for expenditures, are approved, then the next stage is that the operator raises cash calls. Now, because there is no entity, there is no balance sheet, there is no bank account, there are no funds available with the venture. So each partner brings the money at the time of the actual spend. And that's again something that has never been seen in any sector. So that is the level of dynamism in this particular business. So cash calls are raised every month, and based on the cash calls, you have to link those with the authorization for expenditures. Then you have to approve and then release the cash calls to the operator, so that the operator can then spend the money and make payments to the vendors. Now here we are talking of millions and millions of dollars. We're not talking about some small operations, and that's the model that is used across the world, not just in India. So these cash calls have to be reviewed, they have to be audited, they have to be verified, and then approved for release of funds. Once the cash calls are released and the payments made, then after the end of the month, the operator releases the joint interest billing statement to the partners and to the regulators, which basically is the only accounting document that is being created by the operator in relation to the joint venture activities. So there is no profit and loss statement. There is no accounting conventions. There are no guidelines in relation to the manner in which those activities are recorded. So everything has to be agreed between the joint venture partners, and therefore everything has to be assured and everything has to be audited in terms of how those activities then gets listed in the joint interest billing. So these are basically statement of accounts, so to speak, for every partner. And these joint interest billing then gets accounted in the books of accounts. So for instance, BP would then use these JIBs to record that as spend in their books once that comes from the operator. So this therefore then becomes a statutory document and becomes very important for the purpose of making sure that it can be relied upon. So this is how the sort of overall accounting and operations of the upstream sector works. And at each stage, as I explained, there is a significant role for chartered accountants to provide support, to add value, to review. But obviously, it requires detailed understanding of the production sharing contracts, about the joint operator agreements, about the sector, about the regulations, about international practices. So it requires deep knowledge and understanding, but at the same time, the opportunities are immense. Apart from that, I mean, this is basically the ecosystem, but in relation to the routine audit exposure that comes along, that obviously has to be also looked into. For instance, usually the operators will allocate cost from their existing infrastructure. So that would not be very simple to audit because that would be either on the basis of time sharing or time writing, or it could be on the basis of the time where those resources were deployed. So for instance, Shell may have its own vessels and it may be using those vessels for say 5 fields that they may be operating. And each of those 5 fields will have different joint operating agreements. So there has to be a mechanism developed about how then Shell would allocate the cost of those vessels into each of those fields, and how then records would be generated which can be audited and can be assured. So just giving a small example, but that's by itself is something that requires deep knowledge and understanding of the fairness and the transparency of the allocation of cost. Likewise, how the expenses are incurred. As I mentioned, there are no profit and loss. We have no system of accrual. We have no system of provisioning. So it is very important to understand how the expenses are recorded, how they are booked, how they are linked to the contracts, how each of the elements of the contracts can be linked to the joint interest billing that gets charged to the partners. So that whole cycle, or the whole wheel that runs has to be really understood threadbare, so that you can then understand or provide a broader assurance on the fairness and the accuracy of the cost that ultimately gets incurred by each of the partner. So that's one major part where assurance is needed, and major areas are required, expertise are required. The other part is in the contract award and management, because here we're talking of multi-million-dollars of contracts. Each contract value would be upwards of $300 million, $400 million, because what does upstream business do? They award contracts or installation of platforms for drilling of wells, for hire of vessels. Each drilling vessel cost an upward of $20 million a day. That is how costly it is. And so each and every element of the contract award cycle becomes very important. So it starts from how the scope gets decided, what technical specifications gets decided in relation to the development of the scope. What is the overall approach on the scope of sort of from the technical side, from the commercial side, from the execution side. So that has to be very, very well developed. That has to be understood by the auditors so that they can then place reliance that it was done with fairness and transparency. And then, it actually resulted in value to the organization and to the joint venture. So understanding of the scope becomes very, very important. It requires technical expertise also. And then once that's decided, then one has to then decide, which are the bidders who needs to be invited. Now, this is a very closed industry. It is not like you can just publish an advertisement in the newspaper and then you will be able to find vendors. And as I mentioned, there are very few vendors available in India. So most of these vendors would be global players. And therefore, each of the partners may have their own set of vendors that they would like the JV to work with. So what becomes really important is to understand how the bidders get shortlisted, on what basis, on what criteria, what are the technical specs that gets into play for the selection of the vendors. And then the whole process of the bidding, how fairly it is managed. This is not where you are churning out thousands of purchase orders in a month. Maybe you would be awarding just 4 or 5 contracts in a month, but then each of those would be millions of dollars. So therefore, the whole process of the review of the bids and the comparison of the commercial and the technical aspects of the bid becomes so critical and becomes so important because there can be so many things that can be manipulated, or something can actually result into a huge impact for the joint venture. So everything has to be seen in so much of detail. Every contract gets reviewed by the operating board of the joint venture, and therefore the operating board would need a lot of inputs from the audit team and assurance team before they can approve the award of the contract. So a huge expertise is needed in understanding the scope and understanding the ecosystem of each of those services. And here again, as I mentioned, that there is no competency available in India to understand the scope of these contracts and these projects. So usually, most of the companies would then have to bring very costly assurance providers from outside India, usually from Europe, and their billing rate is, I would say, 10 to 20 times the average cost which any consulting firm in India would be billing. And that is the kind of potential that exists in this sector for our professional friends. So this is where you can add the maximum value by identifying where there is a scope creep, or there is an excessive requirement which is not needed for the actual execution of the work, or for that matter that there is some manipulation in the way in which the bidders get selected. And these are multi-million-dollar contracts, so it's a huge scope and a huge value add opportunity for people in the sector. And then the award of the contract is the start of the whole process. The real work comes in the evaluation of the contract management. So if, for instance, the contract is to implement a wellhead platform, that will be usually a year or a 2-year project, and that itself will be a huge task. So the whole contract and project management will then need assurance in terms of the engineering design, how the actual execution is happening against that, whether there is a change of design, whether there is a change of specs in the equipment that are used, how then the project is being implemented. Is it in according to the schedule and the plan, or there is a change in that? How then the actual risks associated with failures, for instance, any unforeseen circumstances or any natural hazard, whether there are adequate insurance covers, whether there is ability then to fall back on the vendors, how then the whole arrangements are being made to make sure that the economic interest of the partners are secure. So that project management is again a significant scope, and the audit of that and the assurance on that becomes a huge area. And then once the contract is over and the project gets completed, then the contract closure becomes so important. Trust me, I mean, each contract closure is a month-to-month activity, because it's, there are so many activities that gets performed, $200 to $300 million contracts, and understanding and the scope delivered under each and every milestone, and then certifying that those were actually delivered according to the contract. Listing all the recovery requirements, deficiencies in performance. It is a huge task. It is not something that can be done in a matter of day or two, and therefore that by itself is a significant task. The contract closure happens, that gets signed off by all the joint venture partners, and that's how you then move to other projects and other contracts. So that's the whole sort of micro view on just one element of scope in the whole upstream assurance activities. Yeah, but I would say one of the major areas. So to conclude our presentation, it's obviously not possible to cover everything in 1 hour, but I hope I have given a glimpse of the assurance universe in the upstream sector. So this is basically how I can conclude. So first and foremost, there is a technical assurance needed, and this technical assurance is needed in determining the quantum of reservoir that exists. As I mentioned, the valuation of the company is based on that, and these are billions of dollars that we are talking about. And if there is a manipulation, if there is a misrepresentation, then that can actually result into a significant impact on the organization. So therefore, it is that significant to make sure or to understand how the reserves are quantified and valued. And that requires huge amount of technical expertise. Also, the seismic evaluation or the evaluation of the data that comes from the seismic surveys, there is again a whole assurance needed on that. So to then understand how then the reservoir was reviewed, how the potential was discovered, how the decision was taken to determine where the exploratory wells will be drilled, that by itself is a huge assurance scope. It's a full technical area, but again, a huge opportunity for people from technical side to provide assurance over here. Project management and development, we briefly discussed. If you have to develop a field, it can be an investment of $1 billion, $300 million to right up to $4 to $5 billion. And therefore, one has to really understand how the field development plan is prepared, whether it is efficient, whether it is going to be optimum in relation to the extraction of the reserves, then the execution of those projects, how they get actually planned, how they get scheduled, how they get developed. Sometimes you may have processing facilities in place, but then there is no production platforms in place. Sometimes you may have production facilities available, but no place to, or no availability of the processing facilities. Again, so these kind of mismatches are very common. And how do you make sure that everything is aligned and there is no value loss in the project execution and development? Here, there is a huge scope because there is a huge commercial aspect to project development. So that's where chartered accountants really need to add a lot of value. Drilling and well services, again, it's a technique commercial area. So each drilling activity requires significant consumption of resources. There is a technique, there is a science of drilling the wells. Also, there is a mechanism to draw hydrocarbons to the ground. So again, it requires assurance that whether the techniques that have been used are actually in alignment with the conditions provided by the host government. The government do not want the reservoir to be damaged by extraction. So they have very stringent norms on how the wells are drilled and how the hydrocarbons are extracted. So here again, there is an assurance required on the techniques that have been used. And from the commercial side, there is a need to see the consumption of the chemicals and other equipments, whether those were commercially rationally deployed and used in the drilling of wells and extraction of hydrocarbons. We discussed about the computation of cost petroleum and profit petroleums. Just to touch upon the profit petroleum concept. So after the cost has been recovered by the operators, there is a profit which results, has to be then again shared between the government and by the joint operating partners. So that itself is an ocean in terms of the computation techniques, the philosophies that are used, what cannot be considered in that. And you would find that there are significant disputes, arbitrations, which are currently happening in India and happens across the world with the host governments in relation to the share of profit that the government takes. So that again is a significant scope area for review. We looked at the whole life cycle of contract management, again, a huge scope. Last but not the least is basically compliance management. As I mentioned, this is the sector that is most regulated, has a significant oversight from the government, and that is in relation to commercial environment, in relation to fiscal, tax, scope areas. So here again, it becomes very important to understand what are those requirements, regulatory conditions, and how then those are managed by the operator. So, for instance, you may be the auditor for a joint venture partner who's not the operator, and then the operator who's actually managing the field is not or has a significant compliance issue. Now, automatically, the risk also comes to the non-operators. So, though they are not operating the field, just because of the fact that they are part of the consortium, they will also have to face the consequences of regulatory action. So when you are representing the interests of the non-operators, you have to make sure or have to review whether the operator is actually having any significant gap or significant non-compliance against the sector regulations, also against the production sharing contract. Because if there are gaps against the production sharing contract, the government will again take regulatory actions. The government may even cancel the license, which has happened in India as well. So it can go to that extreme end. So therefore, it's again important to know what are the important terms and conditions of the production sharing contract and how that is being complied with. And the most important thing is the compliance with the joint operating agreement, because that is where the interests of every joint venture partner are secured. So how then those are actually managed, and whether there is a significant gap in actual operations against the conditions. And if so, then how then that impacts the interest of that particular partner in the joint operating agreement. So this is just a bird's eye view, honestly speaking, of the whole spectrum of activities in the upstream sector, and more importantly, the role that assurance providers can play. The key message over here is that please, if possible, get more understanding in the sector. If there are chartered accountant firms, then they can get empaneled with the DGH to perform audits of various fields and oil and gas blocks. You can actually approach the oil and gas players to do the audit of joint operating agreements. Once you get expertise on this sector, you can actually do international, global, reviews. There's a huge opportunity out there. And I believe that chartered accountants in India are one of the best resources available in the world to add value and to support the sector. So with that, I end my presentation, and then I'm happy to take any questions.
Thank you so much, sir, for your valuable insight and deliberations. There are few questions. Let me read first and then ask you and understand.
Sure.
Acha. One of the participants is asking for a joint operating agreement. There is an opportunity for CA in industry or in a practice?
Both.
Okay.
It's a very good question, and congratulate the guy or the person who asked this question. So I would first talk of the people who are actually in the service. So as I mentioned, that the joint venture operations, and it is like billions of dollars of operations, billions of dollars. It's not like a small time operation. There are no accounting records. There is no profit and loss statement. There is no accounting conventions. There's no balance sheet. So these are prepared just on the basis of how the joint operating agreement has defined those principles on in terms of recording of cost and recognition of revenue, um, cash calls, payments. So there is a huge scope for chartered accountants to sort of perform those activities, because only chartered accountants will understand these complications and the impact of not following those sort of frameworks. In fact, I would take a step back and say that even the framework setting or the development of those principles for how are you going to develop your joint interest billing, what would be the elements, how would you perform your work program and budget related templates. I mean, develop those templates. What would you put in your authorization for expenditure? What level of details? Each of these requires significant element of evaluation and analysis and support. So huge opportunity for chartered accountants in service to support the organizations in performing those activities. And I would say significantly huge opportunity for chartered accountants in practice to provide assurance on all of that. Because there are no accounting standards, because there are no conventions available, everything has to be audited, everything has to be reviewed, because you really cannot have any, there is no statutory auditor can actually confirm this, yeah. So therefore, there is a huge scope for people in practice to provide assurance in the computation and the calculations and the development of each of those work streams, yeah.
Thank you, sir. Next participant asked is the government is focusing on this electric vehicles and electrification for charging the cars and all. So how you see this sector for the next 5 to 10 years, where government is monitoring and focusing on the electrification?
So, I mean, if I can give sort of an example that the coal was discovered 200 years back, yeah, and then obviously came crude after maybe 100 years, but we're still using coal, yeah. We still cannot, because coal happens to be the cheapest form of energy till date for us, yeah. So I'm not saying that there is no need for renewable power. I think the question is related to renewable power, because if the power is generated from coal, then that is coming from the hydrocarbon value chain. Coal is basically hydrocarbon. There is definitely a huge scope for the renewable power generation and distribution in the world economy and in India in particular. But one has to understand the challenges and the constraints in that whole ecosystem. One is energy storage. It is not till date there is no solution available for storing of the electricity that gets generated from renewable sources, because there is so much of variation in the generation of electricity, and we still do not have a viable solution to store that electricity. Then comes the end of distribution. How do you then spend 2 hours in charging a car if you are staying in a city like Mumbai? Is it really feasible? How can you actually manage that? At what points you would be charging? So, and then would you be able to then afford the cost of the electricity as compared to the price of diesel or petrol? So there are significant challenges in the upcoming new energies. That doesn't mean that they do not have potential, but then to say that the current energy source that we have will become unviable is equally wrong, is in fact nothing can be further from truth. So we will continue to use our existing hydrocarbon energy sources, especially in developing and poor countries like Asia and Africa and India. There is no way we can actually just decide that we can shift in 4 to 5 years. Most of the oil and gas companies are talking of 2050, where they are saying that they will be carbon neutral. And they're not saying zero carbon. They are saying carbon neutral. What does that mean? Is that they will produce equal volume of new energies or recyclable or renewable energies as compared to hydrocarbons. So 2050 is a time when they will say that we will reach a parity between hydrocarbons and the new energies. So that is how far it is, yeah. And that too, it is just parity. It is not at all. We can say that it is zero carbon. Plus, petrochemicals is a huge sector and it's a huge growing sector. We will continue to need hydrocarbons for the petroleum sector. I mean, for the petrochemical sector. Today, almost every industry is dependent on petrochemicals. We cannot get away by not having petrochemicals. It is the most easily available and the most, I would say, the most flexible chemical that we can use in most of the industrial applications and our day-to-day life. Gas will continue to be the major, even post renewable energy. Gas is going to always remain in the energy mix. In fact, the proportion of gas is expected to increase further and further in the energy mix. So whatever we discussed today in terms of the upstream activities, gas in terms of distribution, marketing, all of that will continue even after 2050 as far as gas is concerned. So the short answer is that as far as the current generation of chartered accountants are concerned, who are starting their career, they should not worry at all in investing their careers in oil and gas sector. It's a huge sector, it is a growing sector, and will continue to need more and more resources.
How you are implementing ESG in this oil and gas?
Implementing what?
ESG, economic social governance.
So I think ESG is a term that has been suddenly becoming relevant in India. But then if you look at, I mean, all the major countries and all the major oil and gas companies globally, this has always been part of their sustainability agenda. I mean, since decades back. So it's not new as a concept when it comes to the oil and gas sector. As far as India is concerned, it is an emerging concept both for the oil and gas and, of course, for the larger industry. Now, when we talk of ESG, the carbon footprint that comes is not just from the generation of or the extraction of hydrocarbons when you talk of oil and gas sector. There is an element of carbon footprint in every activity they do. Yeah, from transportation to storage to sort of the whole ecosystem of exploration and drilling. So the idea of that, as far as hydrocarbon sector is concerned, is to see where the carbon footprint can be reduced in all those areas, in all those activities. For instance, now you would find more and more cargoes, vessels are actually getting shifted to gas. They're trying finding new technologies how they can actually move vessels on gas. Likewise, you would find that ethanol blending has become mandatory in India. So you have to blend 10% ethanol in petrol. Most of the oil and gas companies are now trying to blend more ethanol than the mandatory 10% requirement so that they can actually then impact the environment. There is a significant portion of investments committed by oil and gas companies in developing new energies and finding the viability of different renewable sources. Yeah, and largely, it may be a controversial statement, but by giving the caveat, I would say that by and large, the biggest contributor of the subsidized renewable sector is coming from the traditional hydrocarbon sector, given the fact that this is a sector that is being taxed the maximum by the government. So right now, the renewable sector by itself is not something that can be viable commercially by itself. So there is a significant portion of support and subsidy that comes from the government, which directly indirectly therefore comes from this sector. We were talking of windfall taxes. Of course, I mean that's something that every host country levies, and a major portion of that therefore then gets contributed in the development of alternate renewable energy sources. So there is a huge huge interface in each and every oil and gas company in relation to ESG initiatives. But it's not new, it has always been there, and it is always going to be continuing in the future as well. And I would say that they would in fact be the key drivers of the ESG transition in the world.
Is there any government subsidy for starting the business? Because there is a initial investment of 15,000 crores. So by and large, this will be involved by the big corporates or multinationals. Any startups will not be right. So is that anything?
So look, I mean, for people who are into business, there are opportunities within the sector. You cannot be just looking at the whole upstream activity and then say that even I would say the largest of the corporates in India would not be having the risk-taking capability to enter into this sector. So therefore, I think if we speak for the business community at large, I would say it is not even advisable to think of investing into the whole ecosystem. But there are so many pockets of opportunities within the sector, yeah, that is available for them, which they can then get into the space. Say, for instance, when you're talking about distribution space, you can actually think of setting up a petrol pump, or you can think of investing in the gas infrastructure by supporting the various initiatives of the gas companies, the distribution companies. You can be the supplier of equipments for them. Like there's a huge requirement for dispensing units or compressing units. You can get into construction activities, support the gas sector in so many ways. So I would say that one can't think of getting into the sector lock, stock, and barrel. There are very few companies in the world that have presence across the value chain in upstream, midstream, downstream, and it's not something that can be done so easily. There are huge geopolitical, uh, initiatives needed. There is going to be huge amount of capital, long-term commitment, and I say long-term means more than 50 plus years of commitment. So definitely not something that every other business group can get into. But within the sector, there are so many opportunities where you can have pockets of investment opportunities.
So just a last question due to shortage of time. One of the let me see. Okay.
Sorry, I lost your audio. Yeah, please go ahead.
Uh, this is the this is the last question due to shortage of time. The panelist, this participant is asking how you foresee India in respect of oil and gas sector in motivating and promoting the Indian economy.
Okay, so Indian economy, in fact, is dependent on the oil and gas sector. So I do not understand the word promoting, because you could see there was a rumor of the transporters going on strike because of the potential regulation that would come, and then suddenly you were finding a situation where the petrol pumps were running dry and people were standing in queue to get their tank up. So I mean, you cannot actually think of having this country run for 3 to 4 days without the source of energy. So I would say that this is the backbone of the country, backbone of the economy. It need not be a promoter. It need not do more than what it is currently doing to make sure that the economy is running. But within that itself, there's so much of opportunity. I mean, there is such a huge value that this industry generates. For instance, the decision that was taken by the government to secure the crude sources for the refining companies in India, where you had a war situation and the crude prices went to the roof. Now that is something that I would say that the government intervention directly helped the sector to make sure that the prices can be kept in control, and at the same time there is no risk on availability of crude. So I would say that you cannot take away the energy sector and say that you can run the country or the economy. But at the same time, if you can run the sector efficiently, effectively, if there can be more discovery of hydrocarbons in the country that can give us self-reliance, I think definitely then the contribution of this sector can further enhance the growth of the economy, can reduce the cost of energy, and then can definitely help our economy grow faster and more efficiently. So I think that's the way I would like to put it. I don't think that there is anything more needed in terms of promoting the economy. Yeah.
Thank you, sir. So last, as a vote of thanks, I stand here with immense gratitude and sense of fulfillment as we are bringing this enriching online webinar to a close. On behalf of ICAI and Committee for Members in Industry and Business, I extend my heartiest thanks to each one of you for being an integral part of this insightful session on oil and gas. Our sincere appreciation goes to ICAI, distinguished speakers, and also the tech team who has worked hard and be with us for whole session. And once again, thank you for your valuable time, engagement, and contribution. We look forward to welcoming you for further events as we continue to explore, learn, and grow together.
All right. Thank you,
Thank
everyone,
you
for
so much.
having me. Great initiative by ICI. Thank you for organizing such events, and have a great day. Bye-bye.
Okay. Thank you, sir. Thank you.